we discuss on this, that is the sales risk-backed transaction. And basically, we'll talk about a sales risk-backed transaction. This whereby a company or basically an entity will basically sell an asset and immediately lease back that particular asset. In most of the cases, this happens whereby the company, for example, wants to raise huge capital, but the asset which the company own, or basically the company own an asset, and because the company is using that particular asset, the company may decide to sell that particular asset. And after selling that asset, the company agree with the buyer that the company will immediately lease back that particular asset. So the main objective here is, number one, for the company to be able to raise the required capital by selling the asset. And then because the asset is still used by the company will be able to do what? To lease back that particular transaction. So therefore, in a sales lease back transaction, how many parties do we have here? Number one, we have the company which is selling the asset, and basically that particular company is basically called the seller. So this company will sell an asset to another company which is called the buyer. So basically this is a sale of assets. So the company selling the asset is called the seller, whereas now the company which is buying that particular asset is called who? Is called the buyer. Now, we are saying after this particular company has leased the asset, the company will lease back that particular asset to who? To this particular company, which is called the seller. So therefore, here we have another transaction, which is basically a lease, which is what? A lease. And because now this company is the owner of the asset, and it is the one which is leasing back the asset, this particular company basically becomes the lessor, whereas this particular company becomes who? Becomes the lessee. Becomes who? The lessee. So therefore, in a sales leaseback transaction, how many parties do we have? We have two parties. So the first party is called the seller lessee. The seller lessee. So this basically the company which is selling the asset and immediately leasing back that particular asset. So selling the asset and immediately leasing back the asset. And number two, we have the buyer. The buyer lessor. So this is basically the company which is buying the asset and basically immediately leasing back that particular asset to who? To the seller. To who? To the seller. So therefore, in a sales leaseback transaction, basically we have how many parties? We have two parties. Now, our main interest as far as this is concerned is basically to look on how these two parties account for this particular what? Transaction. How does the seller lessee account for this transaction? How does the buyer lessor account for this particular what? Transaction? But according to this particular standard here, that is the IFRS 16. IFRS 16. So what each of the party here should basically determine, or what should be determined here for us to be able to know how to account for this particular transaction is whether we have a true sale. Whether we have what? A true sale. So therefore, we are saying IFRS 16 requires that for us to be able to account for this transaction, we need to determine whether this particular sale is basically a true what? A true sale. So whether this particular sale is a true what? Is a true sale. And basically, a sale shall be deemed to be a true sale, if it meets the conditions, which I'll set out at another standard, which is basically called IFRS 15. If you can be able to recall in a file, you came across this standard, and basically this particular standard here deals with the recognition of revenue, from contract with customers. From contract with who? With the customers. From contract with who? With customers. Now, according to this particular standard here, that is IFRS 15, so this particular sale shall basically be a true sale. So, or basically this transfer of the asset shall be a true sale if basically it meets two conditions. If it meets two what? Conditions. Number one, this shall be deemed to be a true sale if the control of the asset has been transferred. The control of the asset has been transferred to the buyer lessor. Has been transferred to who? To the buyer lessor. So what do you mean by the control of the asset? Control of the asset basically is the ability to direct how the asset will be used. This one is the ability. This one is basically what? The ability to do what? To control the use of what? The use of the asset. To control the use of what? Of the asset. So basically what that means is that if the buyer is sold, if this particular company buying the asset and immediately leasing back the asset has the ability to direct how the asset will be used, then in that case, we say that this is a true sale. Is a true what? Sale in accordance with IFRS what? 15. Number two, this shall also be deemed to be a true sale if the risks and also the rewards which are associated with the assets, are basically transferred to the buyer resort. In this case, remember you say that when we talk about the risk associated with the asset, it basically means that if this company here, which is buying the asset and immediately leasing back the asset, has a responsibility to ensure the asset, has a responsibility to carry out the maintenance work, to carry out the repair work, the risks which are associated with the asset have been transferred to this particular company. So if basically these particular conditions have been met, then this one is actually regarded to be a true sale, sale. So if these two conditions are not met in accordance with IFRS 15, so then this transaction here is regarded not to be a true sale. So therefore, if these two conditions are not met, then we say that this is not a true what? Is not a true sale. Is not a true sale. So therefore, for us to be able to account for this particular transaction here, that is a sales leaseback transaction, we need to determine whether this is a true sale, or basically whether it is a true sale, or and basically by checking whether these two conditions are met, or whether it is not a true sale. Now, in this case, I want us to start by looking on how we account for this transaction when it is a true sale. When it is a true what? It is basically a true sale. So once you come across a question like this, the examiner basically will tell you whether, for example, this particular sale, or whether this transfer of the asset is a true sale in accordance with IFRS 15, or basically whether these particular conditions have been met. You must be given some information to help you to determine whether there is a sale or not a true sale. So let's start by looking on how we account for this transaction if it is basically what? A true sale. Remember, we have said this one shall be deemed to be a true sale if these two conditions are met. The control of the asset has been transferred, the risk and rewards associated with the asset have been transferred to this particular company here. And remember, in this transaction, how many parties do we have? We have two parties, the seller, lessee, and basically we have the buyer, lessor. So therefore, I want us, first of all, we start by looking on how we account for this transaction in the books of account of the seller, lessee. So how do we account for this particular transaction in the books of account of this company? So we are saying, how will this company, which is selling the asset and immediately leasing back that asset, how will that company account for that transaction if this is a true sale? If it is a true sale means that the control has been transferred to this company, the risk and rewards have been transferred to this company. So number one, this company here will need to recognize the risk asset. We need to recognize not the risk asset, rather the asset which has been sold, but let's just talk about the asset. So basically, recognize. Remember, in this case, we say to recognize, we say that this is to remove. This is to remove the asset from the statement of financial position. Remember, this is a true sale. So being a true sale, this company must recognize the asset, must remove that asset from its balance sheet. Number two, this particular company here, because it is immediately leasing back that asset, it is immediately leasing back that particular asset, then you have to recall what we said, how how the receipt account for the for this. If, for example, you use an asset, you have been given the right to use an asset, we said you must recognize two items. Number one, you must recognize something called the right of use asset. And number two, you must also recognize something called the lease liability. So therefore, because this company here is leasing back the asset, so it is the receipt, it will recognize the two items, the right of use asset and the lease liability. Number two, we can say that that company will also need to recognize, we need to recognize the lease liability, the lease liability. Is there any difference in terms of how we compute this one? No difference. So this one is equal to the present value of the minimum lease rentals, minimum lease what? Rentals basically not paid at the inception date. Or we can just talk of the present value of the minimum lease rentals or the present value of the lease payment. Present value of the lease what? Of the lease payment. No much difference in terms of how we compute the lease liability. So that is the other thing that our company here should do. The seller receipt. Number three, this company will also need to recognize. We need to recognize something called the right of use asset. The right of use asset. Now, is there a difference in terms of how we compute the right of use asset here with what we did? Yes, there is a difference here. Now, how do we compute this particular right of use asset? To compute the right of use asset here, we take the previous carrying amount. I want you to be very, very keen here. The previous carrying amount before the asset was sold. Before the asset was sold, what was its carrying amount? What was its net book value? You take that previous carrying amount, the carrying amount of the asset, the net book value of the asset before it was sold. You multiply that with the present value. Multiply that with the present value of the lease payment. The present value of the lease payment. Of which this present value of the lease payment is the one which is equal to the lease liability. Is the one which is equal to the lease what? To the lease liability. And basically we divide this with the fair value or the sales proceeds. The sales proceeds of the asset. The sales proceeds of what? Of the asset. You can see here there is a difference in terms of how we compute what? The right of use asset. We are saying take the previous carrying amount of the net book value. This is the carrying amount. This is the net book value before the asset was sold. Multiply that. This should be multiplication. Multiply that with the present value of the lease payment, of which you are saying that this one is equal to the lease liability, and then divide that with the fair value or the sales profit. What is the fair value? The fair value is the amount at which the asset was sold. Is the amount at which the asset was sold. Number four here. Number four. So this company here, because it is selling the asset, automatically, if you are a company and you have sold an asset, you sell the asset at a gain or at a loss. At a gain or at what? At a loss. And therefore, this company here will also need to recognize. We'll also need to recognize the gain or the loss on sale. On sale. On what? On sale. So how do we compute this one? The gain or loss on sale. So first of all, we determine what is called the normal gain, or basically the normal loss. So basically we know how to determine the gain or loss of an asset. So to determine the gain or loss, we take the sales proceeds. So our asset was sold at an amount of how much? You less the net book value, or basically you less what? The carrying amount. So that is basically what is called the normal gain or the normal what? The normal loss. So if basically you get a positive figure, it is a gain. If you get a negative figure, is what? Is a loss. And then we basically multiply this with the fair value of the asset. Remember, in this case, I've said that the fair value of the asset is the same with the sales profit. The asset was sold at an amount of how much? And then to this, we less the present value of the lease payment. The present value of the lease payment. of the risk payment, and then we divide that with the fair value of the asset, which you're also saying is the same with the sales proceed. Is the same with the sales what? Proceed. So therefore, these three formulas here, these three formulas, this one, and basically that one, those three formulas are very, very important. You must remember those particular three. Actually, should be like two, not three actually, because we are saying there is liability computed in the normal way. So the difference comes in when it comes to the computation of the right of use asset. We are saying we take the previous carrying amount of the net book value times the present value of the risk payment. We divide that with the fair value or the sales profit, and then we compute what? We compute the normal gain. The normal what? The normal gain. So remember, this company is selling the asset. It must recognize a gain or a loss. So which is equal to the sales profit minus the net book value or the carrying amount. We multiply that. So this is basically a multiplication. We multiply that with the fair value, which is the same with the sales profit, minus the present value of the risk payment, divided that with what? With the fair value of the sales what? Or the sales proceed. So those two formulas, this one and that one, very, very important. So therefore, in case the transaction is a true sale, so this company here basically should account for this transaction by recognizing the asset, recognizing the risk liability, recognizing the right of use asset, and recognizing the gain or the loss on the gain or loss on the sale, the gain or loss on the sale, on the sale. So on the other hand, this company here, that is the buyer 𝐻𝐿, how will this company account for that transaction if it is a true sale? If it is a true sale. So if it is a true sale, this company here, that is the buyer 𝐻𝐿, number one, this company must recognize the asset. Must recognize what? The asset. Must recognize the asset. Remember, this company has bought the asset. So the reward and the risk have been transferred to this what? Company. So that company, first of all, recognize the asset. Automatically, the asset is recognized by making the normal double entry. So debit the specific asset account, and then if the company paid the money through check, we credit what? We credit bank. So that company should first of all recognize the asset, and number two, then account for the risk. Account for the risk as either operating or very limited is the lessee, is the company which was given the right to use an asset, whereas now the supplier is the owner of the asset. So if you go to the requirement, you're required to analyze the accounting treatment of the above this transaction in the financial statement of who? Of Perry. So in other terms, you're required to illustrate how Perry Limited, who is the lessee, was supposed to account for this particular risk. And remember what we said is that once a company leases an asset, so that company should recognize two items: the risk liability, the right of use asset. But remember, we also talked about two exceptions in relation to that. You may come across that theory question whereby you are asked to give two circumstances, two instances whereby the lessee will not be required to recognize the risk liability and also the right of use what? Asset. So we talked about two circumstances. Number one, we talked about a short-term risk. If you lease an asset for a short period of time, a period which is less than 1 year, you are not required to recognize the risk liability and the right of use asset. Number one is therefore where the risk is a short-term risk. Number two is whereby the risk asset is of a low value. If you lease an asset which is regarded to be of a low value, you are not required to recognize the risk liability and the right of use what? Asset. But this company, Perry Limited, basically on the date the risk commenced, the company needed to recognize two items: the risk liability and the right of use what? Asset. We said always we start by computing the risk liability. We start by computing the risk liability, And basically, we compute this on the date when the risk commenced. In other terms, we compute this on the inception date of the risk. So if you go back to the information we have in the first paragraph, the first sentence, this risk was entered into on 1st of December 2020. That is when this company, Cherry Limited, risked that particular item of machine. So we need to compute the risk liability. How do we compute this risk liability? We say that this one is equal to the present value of the minimum risk rentals not paid at the inception date. Not paid at the inception date of the risk. Inception date of the risk. Not paid at the inception date of the risk. So we discount those particular minimum risk rentals, but which were not paid at the inception date. So basically, if we go back to the information still which we have in paragraph 1, we are told that this company leased an item of machine for a period of how many years? For a period of how many years? Are we given? Yes, for a period of 4 years. I hope you can see that in the first sentence. So this therefore is the risk for how many years? Is the risk for 4 years. Year 1, year 2, year 3, year what? Year 4. So how are the minimum risk rentals payable? As per the information we have in sentence number 2, we are told the terms of the risk were that Cherry Limited was required to pay annual risk rentals or annual rentals of 1.55 million in arrears. In arrears means what? At the start or basically at the start or at the end of the year. Who can tell us? In arrears means what? At the start or at the end? At the start or basically at the end? Yes. In arrears means at the end. So this amount was payable at the end. So the amount which was supposed to be paid at the end of year 1 is 1.55 million, 1.55 million. At the end of year 2, at the end of year 3, 1.55 million, 1.55 million. And therefore, if you check this particular question which you are doing here, you should be able to note that it is different from the other question which we did. I hope you can remember the other question which we did in class the other day, a question which was examined in December 2024. So remember the risk rentals, the minimum risk rentals were payable at the start. So therefore, I want you to see the difference. Rin, I think there was a question which was asked by Rin. There was a question which was asked by Evans. So in terms of the difference, whenever the minimum risk rentals is payable at the start and also at the end, we say there is a difference in terms of how we compute the risk liability. Number 2, how we prepare the risk amortization schedule. Remember, therefore, all these particular amounts are payable at the end. So how do we compute the risk liability? We discount the minimum risk rentals not paid at the inception date. Now, this amount, all of them, you can see they were not paid at the inception date because there is no amount which was paid there. Because we said we discount everything excluding the amount paid at the inception date. So we will take 1.55 million. We multiply this with the present value interest factor of annuity at which rate? At the rate of 13%. At the rate of 13%. The rate of 13%. Then what will be our N here? Our N will be 1, 2, 3, 4. So we are discounting minimum risk rentals for how many years? For 4 years. Yes. So for 4 years. But remember, if this particular amount were payable in advance, so for example, this amount was paid here at the start of year 1. This was paid at the start of year 2. This was paid at the start of year 3. And this one was paid at the start of year 4. What would be the difference? The difference would be our N here. Our N should be 3. Our N should be 3 because we just need to discount what was paid there, and there. So the amount paid at the inception date should not be discounted. Yes. So let's work out this. And I think in our case, we already have this value. Remember, we said in case the examiner has not given you this is the formula you have to recall. 1 minus 1 plus r raised to power negative n. We divide that with r. So that is the formula you need to remember. But I think in our case, we already have this value here. In the last paragraph, you're told the present value interest factor of annuity at 13% for 4 years. This one is given as what? This one is given as 2.97447. So if you work out this using this particular formula, you have 1 minus 1 plus r. Remember, our r is 13% raised to power negative n. That is 4. And then you divide that with 0.13. You should get that value there. Yes, we multiply that with 15. 50. So what would be our risk liability here? What would be our risk liability? What would be our risk liability? We try to hurry up so that we do at least more questions. What are you getting? So I'm getting a value of 4610,428.5. Yes, so basically that is the value I'm getting. Yes, I think we can work with that figure like that. Yes, so that basically would be the risk liability. Now we said, even before we move to compute the right of use asset, what do we need to do with this risk liability? We need to amortize it. Before we proceed to compute the right of use asset, can we amortize this? So let's amortize this by basically preparing the risk amortization schedule. There is amortization schedule. There is amortization schedule. So you'll also be able to see that there is difference in terms of how we're going to prepare this with what we did in the other question, simply because these minimum risk rentals are payable at the end. So take into account our risk is basically for 4 years. We need to have 4 years here, or you can have the specific dates when those 4 years were ending. So those specific dates are given in the requirement. If you go to the requirement, so you'll be able to see that you're given those specific dates. The first year ended 30th of November 2021, 30th of November 2022, 30th of November 2023, and 30th of November 2024. So then the next column here should be for the risk liability at the start of the year. The next column will actually be for the interest. The next column will be for the interest, and this one we computed at the rate of 13%. But remember, if these minimum risk rentals were payable in advance, so after the risk liability, the next column should be forward for the cash paid, for the minimum risk rentals paid, if this one was payable at the start. Sasa? Yes, but because it is payable at the end, so the next column should be for the interest. The next column should be for the minimum risk rentals, paid. And finally, we have the risk liability at the end of the year. So that's basically how we arrange our risk, the risk amortization schedule. And therefore, you can see always we interchange these two columns, depending with when the minimum risk rentals is payable. Can you be able to see that difference with what we are doing here and the other question which we did in class? Rin, can you be able to see the difference? Evans, can you be able to see the difference? Yes, I want you to see that difference. There is always a difference in terms of how we compute this one. There is the risk liability, and actually how we do what we present this. So in case the minimum risk rentals is payable at the end, so after the risk liability at the start, what comes next is the interest, and then the minimum risk liability. Yes. So what we start with here is basically the risk liability at the start of year one, and that is basically what you have computed there, which is basically an amount of 4610 or 28.5. So we compute interest, which will be 13% of this, 13% of the opening balance, 13% of this, and basically I'm getting 599, 356 to the nearest whole number. Let's work with that to the nearest whole number. And then the minimum risk rentals, which was paid at the end of year one, is this one, 1550,000. So this one, we said it reduces the value of the liability. So to compute the risk liability at the end of year one, we will take this one, risk liability at the start of year one, we add the interest, we minus this. So in other terms, to compute this, we are taking what? In other terms, to compute the risk liability at the end, we are taking this one, the risk liability at the start, we are adding this one, the interest paid, we are raising the minimum risk rentals paid. So we are taking A plus B minus what? Minus C. Minus what? Minus C. That's basically how we are getting that value there. Sasa? Yes. So let's work out that. So we add 4610, 428.5 minus 1550. Yes, and basically here I'm getting what? I'm getting 36, 59, 784.5, or let's just work with this to the nearest whole number. Let's just work with that to the nearest whole number. To the nearest whole number, to the nearest whole number, to the nearest whole number, to the nearest whole number. This one should be 9. Eh? Let's work with that. It's 9. To the nearest whole number, it should be that. Eh? Yes. So that will be the opening balance here. 3659, 785. So we compute interest, which is the 13%. 13%. Basically, I'm getting 475, 772. So the amount which was paid at the end of year 2 is this one, which is 1550,000. And then we compute the lease liability at the end of year 2. So we have 3659, 785 plus the interest for 75, 772 minus 1550. Yes. And what are you getting here? My figure automatically is not correct here. Yes, what are you getting? Yes, 25, 85, 557. Eh? Yes, so that will be the opening balance here. 25, 85, 557. So we compute the interest as 13%, which will give us 336, 122. The amount paid is 1550,000. Yes. So let's work out the lease liability at the end of year 3. We have 25, 85, 557 minus 155. Yes, and basically here I'm getting 13, 71, 679. 679. I hope that is what you're getting. So that will be the opening balance here. Is the opening balance here. And then we compute the interest as 13%. 13%, and basically I'm getting 178,318. So the amount paid there is 1550,000. And automatically this one should give a 0 or a figure which is insignificant. So let's see what we have. 178,318. Yes, 1371, 679 plus 178,318. Yes, so I hope you can see this coming for around 3, but essentially it should be 0. Should be 0. The reason why you're not getting 0 is because of rounding off. So therefore, that's basically how we prepare that particular lease amortization schedule, basically to amortize our lease liability. Having said then, we need to move and basically we compute the right of use asset. The right of use asset. And basically the right of use asset, equally we compute this at the inception date of the lease. Remember, the lease commenced on 1st of, this one should be December. It should be December. 1st December of 2020. That is when we are computing the right of use asset. Now, to compute the right of use asset, we said we add like three values. Number one, we take the lease liability. The lease liability at the inception date. And basically that is the inception date is 1st December 2020. So, and the lease liability at the inception date is what you have computed here. 4610, 429. To this we said we add any payment made at the inception date, of the lease. Do we have any payment which was made here at the inception date of the lease? In our case, we don't have any payment which was made at the inception date. We say that you can only have that payment which was made at the inception date, whereby these minimum lease rentals are payable in advance. So if it is payable in advance, automatically the amount was supposed to be paid at the start, at the inception date of the lease. And then to this we add what? Initial direct costs, which are associated with what? With the lease. The initial direct costs associated with the lease. And I think in this question here, we have some initial direct costs which are associated with the risk. Can you see that? Initial direct costs associated with the risk. Who can be able to see that value? It is within paragraph 1, the last sentence. Can you be able to see this? Abdinasil? Amos, can you be able to see that? Yes. Yes. So the initial direct cost associated with the risk is 429, 570. 570. So we add those two values and we get now something called the rate of use asset. The rate of use asset. So the rate of use asset will be 4610, 429 plus 429, 570. And basically we get what here? We get 15. Okay, I think we can work with this one as 0.85, though you can't be penalized for that. So that will give us 50, 39, 998.5. Is that what you're getting? Is that what you're getting? 50, 39, 998.5. Yes. So having that, then the next thing we need to do is basically to compute the depreciation per annum. Remember, we say that this rate of use asset should be depreciated on a straight line basis at the shorter of two periods. At the shorter of two periods, number one, the lease term basically is the period of the lease. In our case, we know this is the lease for 4 years. And number two, the remaining useful life of the asset, or the remaining economic life of the asset. So we're given that in paragraph 2, we are told the machine had a remaining useful life of 6 years. 6 years. So out of the two period, we take the shorter of the, or actually we take the period which is shorter, which is basically 4 years. So we will depreciate this on straight line basis for 4 years. So to compute the depreciation per annum, we will take the rate of use asset 50, 39,998.5. We divide that with 4. We divide that with what? We divide that with 4. So we have 50, 39,998.5 divided by 4. And basically this will give us depreciation of 12,559. 1259 to the nearest whole number. To the nearest whole number, I think should be 1260. Is it 1260? Yes, 1256,000. To the nearest whole number. To the nearest what? To the nearest whole number. To the nearest whole number. To the nearest whole number. Yes. Now, that basically what was required. But if you check on what the question is requiring, we require to analyze the accounting treatment of this in the financial statement. We said, in such a case, what you need to do is you prepare financial statement extract. You prepare the income statement extract. You show what was supposed to be recognized there in relation to this risk. So we start by preparing the income statement extract. We start by preparing income statement extract. And remember, you say that in the income statement extract, what the company is supposed to recognize, 2 items. One, we have these interest. And actually, we say that this interest should be recognized as part of the finance cost. Number 2, the company should recognize this particular depreciation. So, and actually, we are going to prepare this for these 4 years here. The first year edits that year's November 2021, that year's November 2022, that year's November 2023, that year's November 2024, like that. 4 years. So at the expenses, our company will recognize 2 items. At the expenses, so we have these interest. You can just refer to it as interest, or you can just include it here as part of the finance cost, because that will be a finance cost. So this will be the interest for the first year, 599, 356. So for year 2 is this one, 475, 772. For year 3 is 336, 122. And basically this one is 178, 312, 318. Yes, the other item which will also be recognized here is basically the depreciation on the right of use asset. The depreciation on the right of use asset, whatever you have here, this one. And basically this one remains the same for 4 years, 1256,000, 1256,000 fair. 1256,000 fair. Yes, so that is basically what our company here was supposed to recognize in the income statement as far as this is what is concerned. So these are basically the values which will be marked. Remember, we have said whatever, or actually we said whatever you have done here, all these are workings. What earned you the marks is what you have here. Sasa? Yes. So therefore, you must ensure that you have prepared these financial statement extracts. So then from there, we can prepare the statement of financial position, statement of financial position extract. Statement of financial position extract. Extract. Equally, we will prepare these basically for 4 years. That year, the November 2021. That year, the November 2022. That year, the November 2023. That year, the November 2024. 2024, like that. Now, here in the statement for financial position, how many items will be recognized here? 3 items. One of it, David, automatically the figure which you have in the 1250. That will give us what? 1260. The 1260, yeah? To the nearest whole number, David. It's a 1260. Is that the position? Yes, I think this one should be 1260. Huh? It should be 1260. Like that. I think that should be the correct value. Is that the case? 1260? Yes, 1260. I think it is our rounding off, which is basically along here. But basically should be 1260. 1260, yeah? Yes, 1260 like that. Yes. So basically 3 items to be recognized here. One of which is the right of use asset. Now the right of use asset, that one we recognize it as part of the non-current assets. So under the non-current assets, we will have the right of use assets. The right of use asset. Now the right of use asset, we recognize it here at the net book value. So to compute the net book value for the right of use asset, we will take the cost, this one, and then we less depreciation for year 1. When it comes to year 2, we take this one minus depreciation for how many years? For year 2. Forward for year 2. No, you don't need to show that as provided you have recorded that as expenses green. The person who is marking that will be in a position to see that those are expenses, provided they are at the expenses, because these are an extract. That's an extract. Yes, let's compute the right of use asset, the net book value. So we take the cost, which is 39,998.5, and then we minus the depreciation for the first year. This is the depreciation for the first year, which is 1260 x part 4. And basically that will give us what? Will give us will give us 37, 79, 99. Okay, to the nearest number, it will give us something like that. So then year 2, we also do the same. In year 2, you can take this minus that depreciation. Are we together? Yes. So we take, alternatively, you take this minus depreciation for 2 years. But the easy approach is once you have computed the net book value for year 1, to get the net book value for year 2, you take the net book value at the end of year 2, at the end of year 1, sorry, you less the depreciation for year 2. Sasa? Yes, so we will take this, we less depreciation for year 2, which is 1260 x part 4. And basically that will give us 25,19,999. What about there? So we take that value, we less depreciation for year 3, which is 1260. And that will give us a 1260,000. And then here, the net book value will automatically be 0 because it is this minus that. So that's how we compute the value for the right of use asset. Then from there, we said that this particular lease liability, this one should be recognized in the statement of financial position as a liability. But basically, we said this amount has to be split into 2. Part of it will be recognized here as an non-current liability. So under the non-current liability, we will have the lease liability, and still under the current liability, under the current liabilities, we will also have what? The lease liability. We will also have the lease liability. I think I I showed you how to split that, how to determine the amount to be recognized under the non-current and also under the current. We said, I think whatever is very simple is first of all to determine the amount to be recognized under the non-current liabilities there. Under the non-current liabilities there. So we said the amount to be recognized as a non-current liability at the end of year 1, that is this year, we take the lease liability at the end of year 2. So the amount to be recognized as a non-current liability in year 2, we take the lease liability at the end of year 3. At the end of year 3, we take the lease liability at the end of year 4. At the end of year 4, the lease liability at the end of year 5. So therefore, in year 1, the first year here, the amount to be recognized as an non-current liability is this one. So which is 25,85,557. In year 2 is what we have here, 13,71,679. In year 3 is basically 0, and also in year 4 is 0, like that. Yes. Then from there, to determine the amount to be recognized as a current liability, we say this amount payable within 1 year, and therefore we said we take the decrease, because the decrease basically is the amount which has been paid. The reason why liability reduces is because there was a payment which was made. There was a payment which was made. So let's get the difference here between these two values here. We have 36, 59, 785 minus 25, 85, 557. And basically we have a decrease of 10, 74, 228. I hope that is what you're getting. David, the writer, is that what you're getting as the decrease, as the difference between those two values? Is that what you're getting? Yes. So then we move to year 2. Year 2, basically we get the difference between these two values here. The difference between those two values there. That is the 25, 85, 557, 25, 85, 557, and this one minus 13, 71, 679. So and basically that will give us an amount of 12, 13, 878. Yes. And then now in year 3, we get the difference between this. Remember, the lease liability there is 0. So the difference between those two values there is what? Is 13, 71, 679. And automatically in the last year, the lease liability is what? Is 0. The lease liability there is 0. The lease liability there is what? Is 0. Is what? Is 0. So that is it. That's what was required in that question. So what will earn you the 8 marks is basically what we have here. But remember, there is a similar question which we did in your paper 6. That question, the marks allocated there were 10. So meaning that in such a question, you can either be given 8 marks or basically 10 marks. But what I want you to understand is the difference in terms of how we compute the lease liability, how we compute the right of use asset, how we prepare this particular lease amortization schedule whenever the minimum lease rentals are payable at the start of the year and also at the end, because that is the question you're likely to come across. The minimum lease rentals are payable either in advance or in arrears. You must be in a position to compute the lease liability, to prepare this one, and the right of use asset. Yes. So basically that is it. That what was required as far as that question says is concerned. And therefore, I hope that if you happen to come across a question from this topic, the topic of leases, I expect you to score good marks as far as that question is concerned, because I think we have revised from this. Maybe what you also need to do is, can you try to check on how the leases are accounted for by the owner of the asset? The owner of the asset, or basically the lessor. Try to remind yourself how that particular person accounts for the leases. Account for the leases. Account for what? For the leases. Account for what? For the leases. Okay. So we have that. We have another small question here. Basically, I want us we switch now to another topic, a topic of financial instruments. So remember, in relation to that topic of financial instrument, we did a number of we covered a number of concepts. The first concept we did was on compound financial instruments. Compound financial instrument. And remember, I say that compound financial instruments are the financial instruments issued by the company. They contain both equity and liability component. And actually, we say once the company has issued a compound financial instrument, as per the requirement of or as per IS 32, the company should split the two components. The company should split the liability component and the equity component. There is this equally another question here. I want us we go through. Let me share the same. But there is a similar question which we did in class, which is the same with this. Yes, equally I've shared that question in the class WhatsApp group. I've shared that question in the class WhatsApp group. I hope it is clear. I hope it is clear. Is it clear? Whatever I've shared in the class WhatsApp group. Is that question clear? Yes, I hope it is. I hope it is. I hope it is. But before we look on that, can we just take a short break of just like 8 minutes? We come back at 9:10, so that we continue with that question. So we just take a short break of 8 minutes, and then we come back up after that short break of 8 minutes. We come back at 9:10. Yes, so I want us to continue. I hope you're back. I hope you're back. So let's look on this that question here. Let's look on that particular question here. So the question reads, that Good Limited issued shilling 4 million 7% convertible bonds on 1st January 2019 par value. So the bond is redeemable at par on 31st of December 2023, or can be converted at that date on the basis of 2 shillings 1 ordinary share for shillings 10 of the bond held. So we are told the prevailing market rate on 1st January 2019 for similar bonds without conversion rights was 9% per annum. And then you're told that all the interest in the year to 31st of December 2019 has been paid. So what are we required to do here? We are required to calculate the amount to be included in the statement of financial position of Good Limited in respect of the convertible bonds on 31st of December 2019. So now we say that if you happen to come across this question and you see the word convertible, if, for example, you're told a company issued a debt instrument, and that debt instrument issued by the company happens to be convertible, then we say what you need to remember very fast is that this is a compound financial instrument. This is a compound financial instrument. Remember, I said a compound financial instrument. We said that this is a hybrid financial instrument. In fact, in other terms, it can be referred as a hybrid financial instrument. It's a financial instrument which contains both equity component and the liability component. It contains the equity and the liability component. And we say once the company has issued such a compound financial instrument, as per IS 32, the company needs to split the two components, the liability component and the equity component. We look from the steps to be followed. First of all, we said we compute the liability component. Number two, we compute the liability component. So what I want us to do, let's go straight to that question. We go straight to that question. Equally, this is a question I've borrowed from the paper for CFA, financial statement analysis. So this, I think, was from which sitting of CFA? This one from the sitting of November 2020. And this specifically was question number 5A. Question 5A. So We are told this company, which is called Good Limited, our company did what? Issued. The company issued 7% convertible bonds. So take into account, we have the word convertible. Convertible, I'll say that this one is a compound financial instrument. Yes. So therefore, that is very important. That if you happen to come across maybe a question and you're told a company issued some debt instruments and which are convertible, like convertible bonds, convertible loan stock, convertible debentures, you need to remember that that is a compound financial instrument. So therefore, this we can say this is a compound financial instrument and they should be accounted for. Should be accounted for in accordance with what? In accordance with International Accounting Standard number 32. Remember, I said this standard, International Accounting Standard number 32, basically requires that once a company has issued a compound financial instrument, the company should split the two components, the liability component and the equity component. So the first thing we do is to compute the liability component, and then from there we proceed and we compute the liability component. So therefore, step one is basically to compute the liability component. The liability component. And actually, we compute this liability component on the date of the issue. When were these convertible bonds issued? We are told in the first paragraph they were issued on 1st of January 2019. 1st January 2019. 1st January 2019. So we say that this liability component is equal to the present value of the annual interest, the present value of the annual interest plus the present value of the principal payment. Of the principal payment. And actually, you cover similar concept in FM. For example, like when computing the value of debentures, the value of the other debt instrument. Usually, this is a concept you use. You discount the interest to be paid on annual basis and also the principal amount. These basically no much difference with what you do in financial management. Whenever you're required to compute the value of maybe a debenture, the value of a bond, I think it's basically what you do. So what we need to do here is first of all, we compute this one, the annual interest. So we say the annual interest, in other terms, the interest per annum. The interest per annum. How do we compute this? We say the formula is very important because we say that in these questions, you'll be given two rates. You'll be given two interest rates. Which interest rate do we use? We use this one, the coupon interest rate. The coupon interest rate, we say, is the interest name coming before the name of the compound financial instrument. Like the compound interest rate is 7%, and then you multiply that with the par, the face, or in other terms, the nominal value of what? Of the compound financial instrument. So therefore, in our case here, the coupon interest rate, I've said is the interest rate which is given before the name of our CFI, which is 7%. And then still in the first paragraph, the first sentence, we're told the Good Limited issued shillings 4 million, 7% convertible bonds on 1st January 2019 par value. So meaning that 4 million is the par value. 4 million is the par value. Remember, this par value can also be known as the face value, can also be known as the nominal value. The examiner may use any of the words here. Yes. So this will give us shillings 280 million. And remember, this will be paid per annum. This one will be paid per annum. So we already have this. So then from there, we need to determine the principal amount. In this case, we say the principal amount. This is the amount payable on redemption. So once these particular convertible bonds mature, how much amount will be paid on redemption? So that information, we have it within first paragraph, the second sentence. We are told the bond is redeemable at par. That is very clear. The amount to be paid on redemption, this one is equal to the par value. So in our case, remember, we know the par value is how much? Is 4 million. So this is the amount to be paid on redemption, and we must be given the date when they will be maturing. So these convertible bonds, they have a life of how many years? So we are told they will be redeemed at par on 31st of December 2023. So that is the redemption date, and basically that will help us in terms of knowing the life of these convertible bonds. Remember, they were issued on this date. 1st January 2019, we are told they will be redeemed on 31st of December 2023. How many years do we have here between those two dates, between the dates they were issued and the redemption date? How many years do we have there? How many years do we have there? We have the first year, which will end 2019, 31st of December 2019, 2020, 2021, 2022, 2023. 1, 2, 3, 4, 5. Yes. 2019, 2020, 2021, 2022, 2023. And those 5 years all four. They were issued on 1st January 2019. Are they 4 or 5 years? Remember, in this case, the year is supposed to end on 31st of December. Kuna 2019, 2020, 2021, 2022, 2023. Those are 5 years. So the life of these both in 5 years. And remember, in this case, we said, when computing this liability component, we assume that the holders will not convert them into ordinary shares. I think we say that is an assumption which we make. That's why you check on that question. There is somewhere we're given information about how they can be converted into ordinary shares. There is no way we use that information here, because we say for us to be able to compute the liability component, we assume they will not be converted into ordinary shares. That's why that information about the conversion, we don't use it here. So we say to discount this, there are two approaches you can use. Remember, this company here, which issued these bonds, which have a life of 5 years, the life of 5 years, our company is expected to pay this amount per annum. To 𝐻 will be paid at the end of each year. And automatically, this interest is always payable in arrears. This one is payable in arrears. That is the amount to be paid per annum. That is an annuity. And then at the end of year 5 here, the company will also pay this amount of 4 million. So we said to discount, you can either prepare, for example, a table here from year 1 all the way to year 5, and then you have this amount to be paid. Here you have to 80,000, year 2 to 80, year 3 to 80, year 4 to 80, but year 5, we will have to 80,000 plus 4 million. And then you discount this by multiplying that with the present value, interest factor, and which rate do we use in discounting? When discounting, do we use this 7%? No. In discounting, we say we use another rate which is known as the effective interest rate or the market interest rate. And I hope you can see that within the last paragraph. We are given the prevailing market interest rate of 9%. So at the rate of 9%, you get those values, you multiply this with this, you get the present values. Alternatively, we said, because this is the 280 is an annuity, so to discount that to 80, we will take 280. We multiply that with the present value interest factor of annuity at the rate of 9%, and basically for 5 years. For 5 years, then this 4 million, these are lump sum which will be paid basically at the end of year 5. So we multiply that with the present value interest factor at the rate of 9% and basically for 5 years. Remember the formula for getting 𝐕𝐕, and this one is different. So here we have 280. So the formula for getting this is what? 1 minus 1 plus R, which is 1.09, raised to power negative 5. We divide that with R 0.09. That is how we compute that 𝐕𝐕. And then we add this 4 million. So the formula for getting this is 1 plus R, which is 1.09, raised to power negative 5 by such. Sasa, yes. So let's work out this. We start with what we have here, the 𝐕𝐕. So we have 1.09 raised to power negative 5. So 1 minus answer divided by 0.09. That will give us 3.89. Okay, I think we multiply that directly with 280,000. And this will give us 1089. 102. That is basically what I'm getting here. What about this one? 1.09 raised to power negative 5. Is that correct? Can you confirm whether you get that? Yes, so raised to power negative 5 times 4 million. And basically that will give us 25, 99, 726. 726, yes. So we add the two values. And I'm getting a value here of 36, 88, 820, 828. That is basically the value I'm getting here. You can confirm whether you're getting the same. Confirm whether you're getting the same. Are you getting the same? Yes, are you getting the same? Are you getting the same? Yes. So that is the what? That is basically the liability component. The liability component. The liability component. Now, having computed that liability component, step number 2 is to compute something called the equity component. The equity component. And actually, we also compute the equity component on the same date, 1st January of 2019. How do we compute this equity component? We take the cash proceeds. The cash proceeds. Cash proceeds, remember, we say that is the amount of money which was received. Once the company issued these particular convertible bonds, how much amount did our company receive? That information, we have it within paragraph 1. We told the company Good Limited issued shillings 4 million, 7% bonds at par. They were issued at par. The par value is 4 million. The par value is 4 million. So the amount which was received by our company was 4 million because we are told they were issued at par. They were issued at par. So we take that, and then to this we less what? We less the liability component. The liability component on the same date, 1st of January 2019. And that is now what you have computed here. This value here, 36, 88, 828. 828. So the difference here will be what? The difference here will be the equity component. Equity component on 1st January 2019. So, and that will give us 311, 172, 311, 172, 311, 172, 311, 172. So that is basically how we split. We split the equity component and the liability component. Sasa? Yes. So if you happen to come across this question and you see the word convertible somewhere, it can either be convertible bonds, it can either be convertible debentures, it can either be convertible on stock. So what is important for you to do, to remember, is that that is a compound financial instrument. Being a compound financial instrument, you need to split the two components, the liability component, the equity component. After doing that, we say that the value for this equity component for the next 5 years remain, the value for this equity component for the next 5 years will remain the same. We remain the same. But basically this one, whatever you have computed here as a liability component, this is what our company has to pay in the next 5 years. This to the company is therefore like a loan. So being a loan to the company, automatically what do we need to do to this? This one we need to amortize. We need to amortize this liability. Because like what our company is required to pay in the next 5 years. So what we need to do is we amortize it. We amortize it. So we amortize this by basically preparing the amortization schedule. The way you amortize a loan, the amortization schedule. So here we will have our 5 years. Our 5 years, I think we can have just year 1, year 2, year 3, year 4, year 5. Although this specifically, this is not what the question was requiring. The question was just requiring the candidate to prepare this for just 1 year. That's why you can see you are required to compute the amount or the carrying amount to be included in the statement of financial position in the past year. That's why you can see the question has just 5 marks. Because we said, if, for example, the examiner requires you to prepare financial statement extract for the 5 year, that question should be you should be given at least 8 to 10 marks. 8 to 10 what? To 10 marks. So what we need to do, can we amortize this? I want us to do it for the 5 years so that you understand. So here we will have what? We will have, remember what we are amortizing is the liability. So here we will have the value, the liability at the start of year one, the liability at the start. The next column here is basically interest, simply because all these amounts, the annual interest and the principal amount, all of them will be paid at the end of the year. How do we compute this one? We compute this using the effective interest rate, which is basically 9%, not 7%. So we don't use the coupon interest rate, we use the effective interest rate. Then here we will have the column for the cash to be paid. And finally, we will have the liability at the end of the year. And even before you record anything, what is, maybe you can start by recording here, is the cash to be paid. Remember, you have seen our company here. In the next 5 years, the company has to pay interest of 280,000 at the end of each year. And then at the end of year 5, the company will also pay 4 million. So therefore, the cash to be paid in year 1 here will be 280,000 to 80,000 in year 2, year 3 to 80,000, year 4 to 80,000. And then now year 5, the company will pay 4 million and 280,000. So 4 million plus 280,000. Then here we need to start with the liability at the start of year 1. Liability at the start of year 1 is what we have here. 36, 88, 828. So then from there we need to compute the interest. So the interest we computed based on the rate of 9% times the liability at the start. So we have 9%, this one, times the liability at the start of year 1, which is basically 36, 88, 828. And that will give us interest of 331, 995. So how do we compute the liability at the end of that year? Just similar to what we have done in that question for leases. So we take this one plus the interest minus the cash paid. So this one will be A plus B minus what? Minus C there. Minus SC there. That's that? Yes. So let's work out that one. So we will take this plus this minus this. The cash paid will be deducted because this one reduces the value of the liability, the value of the liability. Okay. So we have 36, 88, 828 plus interest 331, 995 minus 280,000. 280,000. And basically I'm getting 37, 40, 823. So that will be the opening balance in year 2. 37, 40, 823. And I hope, yes, that is confirmed. So we get the interest, 9% of that. So which is the 336,674. Yes, then we compute the liability at the end of year 2. 37, 40, 823 minus 280,000. So I'm getting that here, 837, 497. So that will be the opening balance there, 837, 497. We compute the interest being 9%. Being 9% of that, 38, 37, 497. 9% of that. And I'm getting what? 345, 375. 375, 375, Yes, 375. Rin, you're getting what? 3797. So meaning that my value is not correct. Someone to confirm whether my value is not correct, It is not correct, It is not correct. Is my figure correct or not? Rin, is my figure correct or not? That is 797. 497. 497, then that will be the opening balance here. That is 797,497. So what would be the interest? What would be the interest there? What would be the interest? 37,97,497. Very hot. The interest. The interest. 341. 775. Yes. So what about at the end of the year? $38, 59, 272. 272. Okay, that will be the opening balance here, 38, 59, 272. Interest, which is basically 9%. 347. 334. 334. That is basically what I'm getting. What about the liability at the end of the year? 38, 59, 272 minus 280,000. Yes, and I'm getting 926, 606. So that will be the opening balance here. 3926, 606. And then we get 9% of that, which is that correct? Huh? Yes, it should be correct. 353, 395. And this one should be 0. That one should be 0. Or basically you get a figure which is not insignificant figure, which is insignificant. Are you getting 0? Are you getting 0? Maybe a figure which is not significant? Yes, yes. So basically that is it, how we amortize that. Now, equally, in such a question, what the examiner require you to do is you prepare financial statements extract. You prepare financial statements extract, and basically the financial statements extract which are required here is number 1, the income statement extract. You show what was supposed to be recognized there, and number 2, statement of a financial position extract. So let's start by preparing this income statement extract. And actually, we will prepare this for 5 years. You can have the specific dates when each year was ending. But I think no problem. You can't be penalized for that. So let's have year 1, year 2, year 3, year 4, year 5. So what is supposed to be recognized in the income statement as far as these compound financial instruments are concerned? So what the company should recognize here is this interest. You see, this interest should be recognized here as part of the finance cost. And actually, that is an expense. That is an item of expense. Is an item of expense. So here, the company will recognize the finance cost. For the first is what we have here, 331,995. For year 2 is this, 336, 674. For year 3 is 341, 775. For year 4 is 347, 334. And basically for year 5 is 353, 395. So this what this company was supposed to recognize in the income statement, basically as an expense, the finance or that interest. Anything else? No. So what about in the statement of financial position? In the statement of financial position equally for 5 years. Now here, the company basically recognized, or supposed to recognize how many items? 2 items. Number 1, this equity component, this one should be recognized in the statement of financial position as a component of equity. As a component of equity. Remember, when preparing this statement of financial position, we start by recording assets. We record non-current assets, current assets, we record equity, and then liabilities. Do we have any item of asset to be recognized here? No. So the next item we should recognize is equity and finally liabilities. So therefore, we start by showing what was supposed to be recognized under equity. Remember, equity, share capital, reserves. Now, this equity component, we come here and we say the company was supposed to recognize equity component of this, over 7% convertible bonds. You can write that in full for your revision purpose. Equity component of 7% convertible bonds. Sasa, yes. The value for the equity component, remember you say that this one will not change over the next 5 years. Over the period of 5 years, that value does not change. 311, 172. 311, 172. 311, 172. 311, 172. 311, 172. That amount will not change. That amount will not do what? Will not change. Then, under the liabilities, the company recognizes this liability component. This liability component, this one will be recognized here as part of the liability. So basically as part of the non-current liability. So we will say under the non-current liabilities, our company recognizes the liability component of 7% convertible bonds. Sasa, liability component over 7% convertible bonds. And basically that is what we have here. This liability component, liability, the value for the liability at the end of each year. At the end of year 1 is basically that 740, 823. Year 2 is 79, that is 3779, 497. Year 3 is 859, 272. Year 4 is 39, 26, 606. And basically, year 5 is what? Is 0. Year 5 is what? Is 0. So basically, this is what should earn you the marks. But remember what we have said is that if you happen to come across such a question, usually the examiner will have given you around 8 to 10 marks. 8 to 10 marks, because you can see the question is quite what? The question is. Yes, good evening, class. Welcome to our today's session. So I think we can continue with our revision. And I hope you are also revising from your side. You are working extremely hard. Take into account you have, I think, like 1 week or less than 1 week for you to sit for this paper. And therefore, I hope you are working extremely hard. Now, I think we had agreed that once we meet today, we can try to look on a number of topics. Those small topics, that is the financial instruments. I think we did a question on leases. There is another question which I have here for leases. Maybe equally, I think we can look on it. And then we see what next. So let's start with that small question on leases. And then from there, we look on something else. So this is a question, I think, from another paper, not specifically from your paper. Not from your paper. That is a paper for a PAR. So let's look on this question here. Let me share the same in the class WhatsApp group. Yes, already shared. So check in the class WhatsApp group. Check in the class WhatsApp group. So once you get the question, please confirm. Once you get the question, you confirm. I've shared that question in the class WhatsApp group. Yes. Okay, confirmed by Rin there. So let's look on that question. It's basically a question on leases. A question on leases. So what are we told here? What are we told here? Yes, so the question is that on the 1st of December 2020, Perry Limited entered into a contract to lease an item of machine from supplier for 4 years. So the terms of the lease were that Perry Limited was required to pay annual rent of 1.55 million in arrears commencing that year of November 2021. Initial direct costs incurred on the lease amounted to 429,570 and were paid by Perry Limited. So the machine had a remaining economic useful life of 6 years at the commencement of the lease, and then you're told the lease did not contain any purchase option for the lessee. Did not contain any purchase option for the lessee. And then you're told the interest rate implicit in the lease was 13% per annum. And then you're told the present value interest factor of annuity PVIVA at the rate of 13% for 4 years is 2.97447. So what are we required to do here? We're required to analyze the accounting treatment of the above list transaction in the financial statements of Perry Limited, for the year which ended 30th of November 2021 or the year 2024. So basically, these are very good questions on leases. These are questions are borrowed from another paper, called FSA, Financial Statement Analysis. These are paper which is done in CIFA. And basically, this was a question from April of 2025, specifically question number 5B. Now, in this case, we are told that this company, which is called Perry Limited, entered into a lease, and this company, Perry Limited, leased an item of machine from a supplier. So automatically, Perry Limited is the lessee, is the company which was given the right to use an asset, whereas now the supplier is the owner of the asset. So if you go to the requirement, you're required to analyze the accounting treatment of the above this transaction in the financial statement of who? Of Perry. So in other terms, you're required to illustrate how Perry Limited, who is the lessee, was supposed to account for this particular risk. And remember what we said is that once a company leases an asset, so that company should recognize two items: the lease liability, the right of use asset. But remember, we also talked about two exceptions in relation to that. You may come across that theory question whereby you are asked to give two instances whereby the lessee will not be required to recognize the lease liability and also the right of use asset. So we talked about two circumstances. Number one, we talked about a short-term lease. If you lease an asset for a short period of time, a period which is less than 1 year, you are not required to recognize the lease liability and the right of use asset. Number one is therefore where the lease is a short-term lease. Number two is whereby the lease asset is of a low value. If you lease an asset which is regarded to be of a low value, you are not required to recognize the lease liability and the right of use asset. But this company, Perry Limited, basically on the date the lease commenced, the company needed to recognize two items: the lease liability and the right of use asset. We said always we start by computing the lease liability. And basically we compute this on the date when the lease commenced. In other terms, we compute this on the inception date of the lease. So if you go back to the information we have in the first paragraph, the first sentence, this lease was entered into on 1st of December 2020. That is when this company, Perry Limited, leased that particular item of machine. So we need to compute the lease liability. How do we compute this lease liability? We say that this one is equal to the present value of the minimum lease rentals not paid at the inception date. Not paid at the inception date of the lease. Inception date of the lease. Not paid at the inception date of the lease. So we discount those particular minimum lease rentals, but which were not paid at the inception date. So basically, if we go back to the information still which we have in paragraph 1, we are told that this company leased an item of machine for a period of how many years? For a period of how many years? Are we given? Yes, for a period of 4 years. I hope you can see that in the first sentence. So this therefore is the lease for how many years? Is the lease for 4 years. Year 1, year 2, year 3, year what? Year 4. So how are the minimum lease rentals payable? As per the information we have in sentence number 2, we are told the terms of the lease were that Perry Limited was required to pay annual lease rentals or annual rentals of 1.55 million in arrears. In arrears means what? At the start or basically at the start or at the end of the year. Who can tell us? In arrears means what? At the start or at the end? At the start or basically at the end? Yes, in arrears means at the end. So this amount was payable at the end. So the amount which was supposed to be paid at the end of year 1 is 1.55 million, 1.55 million. At the end of year 2, at the end of year 3, 1.55 million, 1.55 million. And therefore, if you check this particular question which you are doing here, you should be able to note that it is different from the other question which we did. I hope you can remember the other question which we did in class the other day, a question which was examined in December 2024. So remember the lease rentals, the minimum lease rentals were payable at the start. So therefore, I want you to see the difference. Rin, I think there was a question which was asked by Rin. There was a question which was asked by Evans. So in terms of the difference, whenever the minimum lease rentals is payable at the start and also at the end, we say there is a difference in terms of how we compute the lease liability. Number 2, how we prepare the lease amortization schedule. Remember, therefore, all these particular amounts are payable at the end. So how do we compute the lease liability? We discount the minimum lease rentals not paid at the inception date. Now, this amount, all of them, you can see they were not paid at the inception date because there is no amount which was paid there. Because we said we discount everything excluding the amount paid at the inception date. So we will take 1.55 million. We multiply this with the present value interest factor of annuity at which rate? At the rate of 13%. At the rate of 13%. The rate of 13%. Then what will be our N here? Our N will be 1, 2, 3, 4. So we are discounting minimum lease rentals for how many years? For 4 years. Yes. So for 4 years. But remember, if this particular amount were payable in advance, so for example, this amount was paid here at the start of year 1. This was paid at the start of year 2. This was paid at the start of year 3. And this one was paid at the start of year 4. What would be the difference? The difference would be our N here. Our N should be 3. Our N should be 3 because we just need to discount what was paid there, and there. So the amount paid at the inception date should not be discounted. Yes. So let's work out this. And I think in our case, we already have this value. We already have this value. Remember, we said, in case the examiner has not given you this is the formula you have to recall. 1 minus 1 plus r raised to power negative n. We divide that with r. So that is the formula you need to remember. But I think in our case, we already have this value here. In the last paragraph, you told the present value interest factor of annuity at 13% for 4 years. This one is given as what? This one is given as 2.97447. So if you work out this using this particular formula, you have 1 minus 1 plus r. Remember, our r is 13% raised to power negative n. That is 4. And then you divide that with 0.13. You should get that value there. You should get that value there. Yes, we multiply that with 15. 50. So what would be our lease liability here? What would be our lease liability? What would be our lease liability? We try to hurry up so that we do at least more questions. What are you getting? So I'm getting a value of 4610. 428.5. Yes, so basically that is the value I'm getting. Yes, I think we can work with that figure right now. Yes, so that basically would be the lease liability. Now we said, even before we move to compute the right of use asset, what do we need to do with this lease liability? We need to amortize it. Before we proceed to compute the right of use asset, can we amortize this? So let's amortize this by basically preparing the lease amortization schedule. There is amortization schedule. There is amortization schedule. So you'll also be able to see that there is difference in terms of how we're going to prepare this with what we did in the other question, simply because these minimum lease rentals are payable at the end. So take into account our lease is basically for 4 years. We need to have 4 years here, or you can have the specific dates when those 4 years were ending. So those specific dates are given in the requirement. If you go to the requirement, so you'll be able to see that you're given those specific dates. The first year ended 30th of November 2021, 30th of November 2022, 30th of November 2023, and 30th of November 2024. So then the next column here should be for the lease liability at the start of the year. The next column will actually be for the interest. The next column will be for the interest, and this one we computed at the rate of 13%. But remember, if these minimum lease rentals were payable in advance, so after the lease liability, the next column should be forward for the cash paid, for the minimum lease rentals paid, if this one was payable at the start. Sasa? Yes, but because it is payable at the end, so the next column should be for the interest. The next column should be for the minimum lease rentals, paid. And finally, we have the lease liability at the end of the year. So that's basically how we arrange our lease, the lease amortization schedule. And therefore, you can see always we interchange these two columns, depending with when the minimum lease rentals is payable. Can you be able to see that difference with what we are doing here and the other question which we did in class? Rin, can you be able to see the difference? Evans, can you be able to see the difference? Yes, I want you to see that difference. There is always a difference in terms of how we compute this one. There is the lease liability, and actually how we do what we present this. So in case the minimum lease rentals is payable at the end, so after the lease liability at the start, what comes next is the interest, and then the minimum lease liability. Yes. So what we start with here is basically the lease liability at the start of year one, and that is basically what you have computed there, which is basically an amount of 4610 for 28.5. So we compute interest, which will be 13% of this, 13% of the opening balance, 13% of this, and basically I'm getting 599, 356 to the nearest whole number. Let's work with that to the nearest whole number. And then the minimum lease rentals, which was paid at the end of year one, is this one, 1550,000. So this one, we said it reduces the value of the liability. So to compute the lease liability at the end of year one, we will take this one, lease liability at the start of year one, we add the interest, we minus this. So in other terms, to compute this, we are taking what? In other terms, to compute the lease liability at the end, we are taking this one, the lease liability at the start, we are adding this one, the interest paid, we are raising the minimum lease rentals paid. So we are taking A plus B minus what? Minus C. Minus what? Minus C. That's basically how we are getting that value there. Sasa? Yes. So let's work out that. So we add 4610 for 28.5 minus 1550. Yes, and basically here I'm getting what? I'm getting 36, 59, 784, 784.5. Or let's just work with this to the nearest whole number. Let's just work with that to the nearest whole number. 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 This one should be 9. Eh? Let's work with that. It's 9. To the nearest whole number, it should be that. Eh? Yes. So that will be the opening balance here. 3659. 3659, 785. So we compute interest, which is the 13%. 13%. Basically, I'm getting 475. 772. So the amount which was paid at the end of year two is this one, which is 1550,000. And then we compute the lease liability at the end of year two. So we have 36, 59, 785 plus the interest for 75, 772 minus 1550. Yes. And what are you getting here? My figure automatically is not correct here. Yes, what are you getting? Yes, 25, 85, 557. Eh? Yes, so that will be the opening balance here. 25, 85, 557. So we compute the interest as 13%, which will give us 336, 122. The amount paid is 15,000. Yes. So let's work out the lease liability at the end of year 3. We have 25,85,557 minus 155. Yes, and basically here I'm getting 13,71,679. 679. I hope that is what you're getting. So that will be the opening balance here. Is the opening balance there. And then we compute the interest as 13%. 13%, and basically I'm getting 178,318. So the amount paid there is 50,000. And automatically this one should give a 0 or a figure which is insignificant. So let's see what we have. 178,318. Yes, 1371,679 plus 178,318. Yes, so I hope you can see this coming for around 3, but essentially it should be 0. Should be 0. The reason why you're not getting 0 is because of rounding off. So therefore, that's basically how we prepare that particular lease amortization schedule, basically to amortize our lease liability. Having this 10, we need to move and basically we compute the right of use asset. The right of use assets. And basically the right of use asset, equally we compute this at the inception date of the lease. Remember, the lease commenced on 1st of, this one should be December. It should be December. 1st December of 2020. That is when we are computing the right of use asset. Now to compute the right of use asset, we said we add like three values. Number one, we take the lease liability. The lease liability at the inception date. And basically that is the inception date is 1st December 2020. So, and the lease liability at the inception date is what you have computed here. 4610, 429. To this we said we add any payment made at the inception date, of the lease. Do we have any payment which was made here at the inception date of the lease? In our case, we don't have any payment which was made at the inception date. We say that you can only have that payment which was made at the inception date, whereby these minimum lease rentals are payable in advance. So if it is payable in advance, automatically the amount was supposed to be paid at the start, at the inception date of the lease. And then to this we add what? Initial direct costs, which are associated with what? With the lease. The initial direct costs associated with the lease. And I think in this question here, we have some initial direct costs which are associated with the lease. Can you see that? Initial direct costs associated with the lease. Who can be able to see that value? It is within paragraph 1, the last sentence. Can you be able to see this? Abdinasil? Amos, can you be able to see that? Yes. Yes. So the initial direct cost associated with the lease is 570. So we add those two values and we get now something called the right of use asset. The right of use asset. So the right of use asset will be 4610, 429 plus 429, 570. And basically we get what here? We get 15. Okay, I think we can work with this one as 0.85, though you can't be penalized for that. So that will give us 50, 39, 998.5. Is that what you're getting? Is that what you're getting? 50, 39, 998.5. Yes. So having that, then, the next thing we need to do is basically to compute the depreciation per annum. Remember, we say that this right of use asset should be depreciated on a straight-line basis at the shorter of two periods. At the shorter of two periods, number one, the lease term. The lease term basically is the period of the lease. In our case, we know this is the lease for 4 years. And number two, the remaining useful life of the asset, or the remaining economic life of the asset. So we're given that in paragraph 2, we are told the machine had a remaining useful life of 6 years. 6 years. So out of the 2 period, we take the shorter of the, or actually we take the period which is shorter, which is basically 4 years. So we will depreciate this on straight-line basis for 4 years. So to compute the depreciation per annum, we will take the right of use asset 50, 39,998.5. We divide that with 4. We divide that with what? We divide that with 4. So we have 50, 39,998.5 divided by 4. Divided by 4, and basically this will give us depreciation of 12,559. 1259 to the nearest whole number. To the nearest whole number, I think should be 1260. Is it 1260? Yes, 1256,000. To the nearest whole number. To the nearest what? To the nearest whole number. To the nearest whole number. To the nearest whole number. Yes. Now, that basically what was required. But if you check on what the question is requiring, we require to analyze the accounting treatment of this in the financial statement. We said, in such a case, what you need to do is you prepare financial statement extract. You prepare the income statement extract. You show what was supposed to be recognized there in relation to these risks. So we start by preparing the income statement extract. We start by preparing income statement extract. Income statement extract. And remember, you say that in the income statement extract, what the company is supposed to recognize, 2 items. One, we have these interest, and actually we say that this interest should be recognized as part of the finance cost. Number 2, the company should recognize this particular depreciation. So, and actually we are going to prepare this for these 4 years here. The first year edits that year's November 2021, that year's November 2022, that year's November 2023, that year's November 2024, like that, 4 years. So at the expenses, our company will recognize 2 items. At the expenses, so we have these interest. You can just refer to it as interest, or you can just include it here as part of the finance cost, because that will be a finance cost. So this will be the interest for the first year, 599, 356. So for year 2 is this one, 475, 772. For year 3 is 336, 122. And basically this one is 178, 312, 318. Yes, the other item which will also be recognized here is basically the depreciation on the right of use asset. The depreciation on the right of use asset, whatever you have here, this one. And basically this one remains the same for 4 years. 1256,000, 1256,000 fair, 1256,000 fair. Yes, so that is basically what our company here was supposed to recognize in the income statement as far as this is what is concerned. So these are basically the values which will be marked. Remember, we have said whatever, or actually we said whatever you have done here, all these are workings. What earn you the marks is what you have here. Sasa? Yes. So therefore, you must ensure that you have prepared these financial statement extracts. So then from there, we can prepare the statement of financial position, statement of financial position extract. Statement of financial position extract. 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 Equally, we will prepare these basically for 4 years. That year, the November 2021. That year, the November 2022. That year, the November 2023. That year, the November 2024. 2024, like that. Now, here in the statement for financial position, how many items will be recognized here? 3 items. One of it, David, automatically the figure which you have in the 1250. Oh, that will give us what? 1260. The 1260, yeah? To the nearest whole number, David. It's a 1260. Is that the position? Yes, I think this one should be 1260. Huh? It should be 1260. Like that. I think that should be the correct value. Is that the case? 1260? Yes, 1260. I think it is our rounding off, which is basically along here. But basically should be 1260. 1260, yeah? Yes, 1260 like that. Yes. So basically, three items to be recognized here. One of which is the right of use asset. Now, the right of use asset, that one we recognize it as part of the non-current assets. So under the non-current assets, we will have the right of use assets. The right of use asset. Now, the right of use asset, we recognize it here at the net book value. So to compute the net book value for the right of use asset, we will take the cost, this one, and then we less depreciation for year one. When it comes to year two, we take this one minus depreciation for how many years? For year two. Forward for year two. No, you don't need to show that as, provided you have recorded that as expenses green, the person who is marking that will be in a position to see that those are expenses, provided they are at the expenses. Because these are an extract. That's an extract. Yes, let's compute the right of use asset, the net book value. So we take the cost, which is 50,998.5, and then we minus the depreciation for the first year. This is the depreciation for the first year, which is 1260 x part 4. And basically that will give us what? Will give us will give us 37, 79, 99. Okay, to the nearest number, it will give us something like that. So then year two, we also do the same. In year two, you can take this minus that depreciation. Are we together? Yes. So we take, alternatively, you take this minus depreciation for 2 years. But the easy approach is once you have computed the net book value for year one, to get the net book value for year two, you take the net book value at the end of year two, at the end of year one, sorry, you less the depreciation for year two. Sasa? Yes, so we will take this, we less depreciation for year two, which is 1260 expand 4. And basically that will give us 25, 19, 999. What about there? So we take that value, we less depreciation for year three, which is 1260. And that will give us a 1260,000. And then here, the net book value will automatically be 0 because it is this minus that. So that's how we compute the value for the right of use asset. Then from there, we said that this particular lease liability, this one should be recognized in the statement of financial position as a liability. But basically, we said this amount has to be split into two. Part of it will be recognized here as an non-current liability. So under the non-current liability, we will have the lease liability, and still under the current liability, under the current liabilities, we will also have what? The lease liability. We will also have the lease liability. I think I showed you how to split that, how to determine the amount to be recognized under the non-current and also under the current. We said, I think whatever is very simple is first of all to determine the amount to be recognized under the non-current liabilities there. Under the non-current liabilities there. So we said the amount to be recognized as a non-current liability at the end of year one, that is this year, we take the lease liability at the end of year two. So the amount to be recognized as a non-current liability in year two, we take the lease liability at the end of year three. At the end of year three, we take the lease liability at the end of year four. At the end of year four, the lease liability at the end of year five. So therefore, in year one, the first year here, the amount to be recognized as an non-current liability is this one. So which is 25,85,557. In year two is what we have here, 13,71,679. In year three is basically 0, and also in year four is 0, like that. Yes. Then from there, to determine the amount to be recognized as a current liability, we say this amount payable within 1 year. And therefore we said we take the decrease, because the decrease basically is the amount which has been paid. The reason why liability reduces is because there was a payment which was made. There was a payment which was made. So let's get the difference here between these two values here. We have 36, 59, 785 minus 25, 85, 557. And basically we have a decrease of 10, 74, 228. I hope that is what you're getting. David Reiser, is that what you're getting as the decrease, as the difference between those two values? Is that what you're getting? Yes. So then we move to year two. Year two, basically we get the difference between these two values here. The difference between those two values there. That is the 25, 85, 557, 25, 85, 557, and this one minus 13, 71, 679. So and basically that will give us an amount of 12, 13, 878. Yes. And then now in year three, we get the difference between this. Remember, there is liability there is 0. So the difference between those two values there is what? Is 13, 71, 679. And automatically in the last year, the risk liability is what? Is 0. The risk liability there is 0. The risk liability there is what? Is 0. Is what? Is 0. So that is it. That what was required in that question. So what will earn you the 8 marks is basically what we have here. But remember, there is a similar question which we did in your paper 6. That question, the marks allocated there were 10. So meaning that in such a question, you can either be given 8 marks or basically 10 marks. But what I want you to understand is the difference in terms of how we compute the risk liability, how we compute the right of use asset, how we prepare this particular risk amortization schedule whenever the minimum risk rentals are payable at the start of the year and also at the end, because that is the question you're likely to come across. The minimum risk rentals are payable either in advance or in arrears. You must be in a position to compute the risk liability to prepare this one and the right of use asset. Yes. So basically that is it. That what was required as far as that question says is concerned. And therefore, I hope that if you happen to come across a question from this topic, the topic of risks, I expect you to score good marks as far as that question is concerned, because I think we have revised from this. Maybe what you also need to do is can you try to check on how the risks are accounted for by the owner of the asset. The owner of the asset, or basically the lessor, try to remind yourself how that particular person account for the risks. Account for the risks. Account for what? For the risks. Account for what? For the risks. Okay. So we have that. We have another small question here. So basically, I want us we switch now to another topic, a topic of financial instruments. So remember, in relation to that topic of financial instrument, we did a number of we covered a number of concepts. The first concept we did was on compound financial instruments. Compound financial instrument. And remember, I say that compound financial instruments are the financial instruments issued by the company. They contain both equity and liability component. And actually, we say once the company has issued a compound financial instrument, as per the requirement of or as per IS 32, the company should split the two components. The company should split the liability component and the equity component. There is this equally a question here I want us we go through. Let me share the same. But there is a similar question which we did in class, which is the same with this.
To encourage management how they can be able to do to manage the company best, he came up with what? Some of the 14 principles. So that what? If you want to manage a company well, then you have to what? Follow the following 14 principles. That's why he came up with what? With what's called the 14 principles of management. Look at them last week. Then we talked about also Max Weber. There's also another scientist called Max Weber, did more research on the aspect of management. So with him, he emphasized on the issue of what? Structured and formalized organization system. So that what? A company must have a structure. Who is the senior most person, the junior most person? Who do we report to? What's the line of authority? So basically, with him, he talked about what? The aspect of what? Having a good structure. So that as long as a company has got a good structure, then the company will be able to what? Perform better in the business environment. And then we stop at that level. So we are supposed to look at the second category of theorists. So That was on the behavioral approach. Now, today, I want us to look at on another aspect where we talk, that was on the classical approach. So we looked at the classical approach, basically, talked about Taylor, Fayol, and Weber. Now, today, we want to look at what's called behavioral approach. So there are also theories that say that they were trying to help in improving performance of the company, and they dwelt much on what? On the aspect of behavior. So let's look at the behavioral approach to management. So this is the second category of the what's called the classics. Now, what does this entail? What does behavioral approach to management entail? So we said that the behavioral management approach is a school of management thought that emphasizes the importance of human behavior. So these theories, they dwell so much on what? On the human behavior, human needs, attitudes within the workplace. So with them, they were trying to ensure that what? If you're able to control human behavior, if you're able to meet the needs of the employees, if you're able to ensure that the employees have got good attitude, then basically your company is going to what? Perform better. So that is what these theorists emphasize on. So which focus on what? Mainly efficiency and productivity, what? While overlooking the human elements in action. Key contributors to this approach include, so these are the scientists, those who did research. We have 𝐿𝐻𝐻, Abraham Maslow, Douglas McGregor, and Mary Parker Follett. So basically, if you look at some of the past papers, you'll find that somebody asks you to explain a given theory or a given behavior in relation to 𝐿𝐻𝐻, in relation to what? Abraham Maslow, also McGregor, basically. Okay, Florence, that is noted. But what was happened that in the the classical approaches, we had done them last week. That's why I was just perusing through so that we have the continuity. I was not moving very fast. I was just trying to pass through them because we had done them in the previous class. That's why I was just brushing through them. But now we are starting to discuss. Now the pace is going to be a little bit slower. Those ones I was perusing through because we had already done them in the previous class. So for the continuity, I was just trying to get a recap, Florence. But that's noted. Now let's look at what? Let's now look at the behavioral management approach. How can organization help in managing the behavior to ensure that what the company becomes more productive? Now, those who contributed to this theory include 𝐿𝐻𝐻. They did research and their findings and their theories are there. We have somebody called Abraham Maslow, also did research on this aspect and came up with some of the ways of motivating employees. Then you also have what? Douglas McGregor and Mary Parker Follett. So we're going to look at some of the theories by those researchers or those gurus of management. Now, the first behavioral approach to management, or the first theory that we want to look at in support of the behavioral management approach, is what we call 𝐿𝐻𝐻. And 𝐿𝐻𝐻 emphasized on what's called what? Human relations theory. So we want to look at 𝐿𝐻𝐻. What did 𝐿𝐻𝐻 do, and what was his findings, and how can his finding help us what? In managing an organization. Which approach, Florence? Which approach are you talking about? We have talked about, okay, let me go back so that you understand what I'm saying. So that the behavioral management approach is a school of management thought that emphasized on the importance of what? Human behavior. So these people look at how can we change the human behavior to be able to increase productivity. How can we be able to look at the needs of the employees? For example, can we satisfy their needs so that they become very productive? Employees whose needs are satisfied by the company are normally very motivated and very much productive, and also attitude. Can you be able to change the attitude of your employees so that they become what? People who are oriented, or people who are focused on helping the company achieve its own objectives. So basically, this theory is all about look at the human behavior, needs of the employees, and attitudes. So ensure that what? We have a conducive work environment so that the company becomes more productive. Lawrence, are we good now? Are we okay? Good. Now, the first person who supported this behavioral management theory is a researcher by the name 𝐿𝐻𝐻. So 𝐿𝐻𝐻, on his theory, he talked about what? Human relations theory. So in his research, he was looking at what? Human relations and how it can help a company move towards what? Achieving its objective. Now let's look at, so that 𝐿𝐻𝐻 was a key figure in the development of human relations movements, which emphasized the social needs of workers and the importance of interpersonal relationship in the workplace. So according to him, he looked at how can we be able to improve the social needs of the employees, and how are we able to improve relationship. There must be a good relationship between the employee themselves and the employees and management. If you are able to emphasize on those relationships, then basically the company will be able to perform better. So he dwelt on, look at what? How can we improve the social needs of the worker? Employees need to belong. Employees need to feel like what? People appreciate them in the company. Employees need to have a support system around them. At the same time, how can we be able to improve the interaction or the relationship among the employees themselves and between the what? Employees and management? Now, in this theory, he came up with some key concepts. Number one is that Mayo conducted the Hawthorne study in the Western Electric Company. He did that in 1924 to 1932. That means it took 6 years in carrying out that research. This is a good researcher. It took a lot of time in trying to what? Trying to carry out this research. Now, which aim to study the effect of physical conditions on productivity. So look at what? How can the physical condition of the company affect productivity of the organization? The results showed that social factors such as what? Feeling valued, that's a social factor, feeling valued, such as feeling valued, feeling valued and being part of the team has greater influence on productivity than what? Than physical condition. If I'm in a place where I feel like my employees, my fellow employees trust me and my manager trust me, then basically I feel motivated to be able to what? Help the company achieve its objective. Now, what were key findings from this theory? When 𝐿𝐻𝐻 was doing this research, what was his key findings? What did he find out from this Hawthorne study? So he said that the first thing he found out was called the Hawthorne's effect. Now, what is this thing called the Hawthorne's effect? That workers' performance improved because they knew they were being observed and felt that management cared about them. So employees believe that whatever we are doing being done, when managers are observing what we're doing, then we tend to do work, be motivated to work. At the same time, when managers feel like we are valuable to them, manager values us, managers see value in us. Most of these companies people work for, you find that there's a term that most managers use, or most people in authority use, and they tell you that we can do without you as an employee. So that means there's no value. They look at you like what? You're a liability. You must know that the employees you have are your first asset. Anybody who is in management here, the people you are leading should look at them like an asset. It's okay, you can fire them and get a new employee, well and good, but what you know to know that what? You will never get an exact employee. You can get a better one or the worst employee than the ones you have. So basically, try to value employees in their own aspect. Now, this second finding is that what? Informal work groups, so that social groups within the workplace strongly influence individual behavior. Now, when we talk about social groups, there's what's called social formations within a work environment. All of us may be working. I'm using may because I don't know exactly. Most of us may be working in organizations, whether private or public institutions. Now, there's what is called social formations within the workplace. There are people that you just feel comfortable around. Nobody told you to be friends with them, but as you continue working, you find that you have the same ideals, you have the same perspective of life. So basically, you tend to gravitate towards one another in the workplace. So when I see Zipporah, let's say in a CZ portal, I see somebody else. So there's somebody that's very close to you at work environment. And then when you don't come to work, people ask you, where is so-and-so? So basically, when you have a strong social fabric within the company, you're able to what? You're able to behave. If the person you interact with is a top performer, automatically you also what? You improve in performance. That's what he says. Then another key finding was on the employee morale. So that high morale increases productivity, low morale leads to what? Underperformance. So if you're able to boost the employee morale, just encourage them, let them know that you value what they're doing. Let them know that what they are trying the best for the company. When you boost employees' morale, basically they become very productive. So that's what happens. So as a manager, find ways in which what you can be able to boost employees' morale. Some people believe that the morale or the motivation of employees is only via money. There are some what's called what? Non-monetary motivation. Recognition that somebody is not good. So basically, find some non-verbal or non-monetary means to be able to what? To be able to motivate employees. Don't just believe that it's only money. Employees, when you give them money, money is one of the major motivation factor. But basically, there are other ways you can use to what? Manage employees so that what you're able to improve their performance. Very important. Now, what is the implication of this Elton-Mayo or human relation theory as per the Elton-Mayo? What is the implication of this theory? How does it help organization, or what is the implication of this theory? So we see that what managers should focus on employee welfare. Ensure that the welfare of your employee is taken care of. Managers should focus on the employee welfare, talk about remuneration, talk about work environment, ensure that your employees are working in a good work environment. The welfare of employees should be given priority. So welfare, communication, ensure that you're able to what? Pass information as and when needed so that employees don't get wrong information. And also what? Group dynamics. You must know how to manage groups. You must, anytime we are in a company is a social setting. So there's bound to be these groupings. How do you manage these groups? You must know who is the most influential in that group. That's what? If you want to bring an issue, you will bring issue through them. That's what happens. You need to know your employees, which of your employees has more power than the rest, who can influence who. So basically look at that. Then the second implication is that encourage participation and teamwork to boost productivity and satisfaction. Ensure that employees work as a team, not as individuals. Ensure that you create teamwork. When you create teamwork, employees will become. So for example, in a department, every member of the department should work to ensure that then we achieve what's called departmental objective. Those who don't work as a team, sometimes you may be a very good employee in a given company, but you tend to be so individualistic. You can be fired, however good you are, because sometimes we need what's called collective work. We need everybody else to be bottom. So if you're somebody who try to just divide the group, or you want to be seen as you are the most performing employee, you don't want to lift others, and sometimes for the sake of the company harmony, you may be let go and you wonder now, this was one of our best employees. Why did he go? Because there's an aspect of he's not working with the rest. He's not a team player. He's good individually, but now there's some jobs that requires Requires a departmental effort. So if you are somebody who wants to do things separately, then basically sometimes you may feel like or you may hinder what's called the overall goal of the company. So basically, that's what Elton-Mayo did. He did a research, and these were his findings. We talked about the findings, and also we look at implication. How can this theory help us to ensure that we manage now? So if you decide that I want to apply Elton-Mayo or human relations theory, then you know what he did, what he found, and how you're able to motivate the employees to be able to perform better. Now, on the Elton-Mayo or human relations theory, are we good? Mwalimu, it's another point here. Florence, I think I'm moving at a very slow speed now. I'm moving at a very slow speed, Florence. I'm too fast. Hey. Let me ask the rest. What do you think about my speed? Maybe I need to get a second opinion. Yes, if all of you say that I'm too fast. Okay. Mutie is also saying that I'm very fast. So Florence and Mutie are saying that I'm too fast. The rest are saying that we are poor. So what? I think this theory I've taken too much time to explain, but there's no problem. We'll go. We'll try. Let me repeat on this theory so that at least everybody is at par. But at the same time, we must know that we have. This is a professional course. It has got, like, I think this one should be having like around 11, 12 topics. So we also need to what? Balance. We'll balance the speed at the same time, try to ensure that there's understanding. So I'll try to understand. I understand you, Florence. I understand what you're saying. I understand what we'll see. We'll see. Okay. Maybe Florence. Do you have the notes that I've shared? I've shared the notes in the group. Maybe you don't have the notes. Do you have the notes? I'd share the notes in the group. So you're still making other notes? What you do, okay, this is just a suggestion, Florence. If you're able to print the note, if you're able to print them, understand the situation. If you're able to print the notes, then you can be making short notes on the notes that you have, so that you have the hard copy. You are reading the hard copy that you have at the same time. Make notes on that hard copy so that we are able to move on well. But I understand your fear that this is a receipt and you want to understand maximally, which is okay. But at the same time, we'll try to find a balance in which we move at a good speed. At the same time, we try to cover the syllabus. So I'll try to find a balance. I understand, Florence. I understand what your point, but also if I go slow and then we finish at topic 5, the semester end when you're topic 5, basically, will not have. So I'll try to become moderately slow so that at least you understand at the same time we cover the syllabus. Because if I don't finish the syllabus also, it acquire another problem. So we need to balance. We need to balance. To cover syllabus pia na pia speed yetu ikuwe ile ya ku understand. So let us all try to balance. But here, Florence, have you been in this class last time? Were you here last time? Oh, you are in RCM, yes, understand. But I can tell you that those who were here last time, all of them passed the exam. Because we revised more than 10 papers. We finished the syllabus and revised more than 10, not one. To revise, in fact, we revised the CPA past papers of PPM from around 2020, tukamaliza, tukaingia ya CS. Because CS also has got what? A principle of management. CPA has condition management, but the same thing. So we revised like 10 papers. Tulimaliza ya CPA, tukaenda mpaka ya CS from around 2020. So we'll do that so that ukienda kwa mtihani utakuwa sawa. That's why we are trying to what? Balance. Balance. So Florence, in case you need any assistance also, just inbox me. Inbox, then basically you can be able to what? Help. So we are here for everybody else. So kila mtu anatoka paka mbita. Last time tulikuwa na 100% pass. If you believe I'm lying, ask anybody. You can ask Mr. Kiana or Mr. Dongo, atakwambia hapa tunang'ang'ana to ensure that what everybody pass. So that on so we revised more than 10 papers last time, I can assure you, and everybody came up. And there's somebody also came from another college here who was also very much afraid. Like in today, we ensure that every pass. So we'll balance that one, understand. So let me repeat it for the sake of all us having harmony. Let me repeat this one once. So let's look at 𝐿𝐻𝐈𝐍's human relation theory. So this guy called 𝐿𝐻𝐈𝐍 did a research to be able to what? To look at, say that he did a research on the aspect of what? Social needs of workers and importance of what? Interpersonal. Means what? So that if you're able to meet the social needs of workers at the same time, ensure that there's a good relationship between or among the employees, then basically you are able to ensure that what? We become very productive. So I'll be reading and then I explain. That's why I'm highlighting. So that 𝐿𝐻𝐈𝐍 was a key figure in the development of human relations movement, which emphasized the social needs. So he emphasized the social needs of workers and the importance of what? Interpersonal relationships in the workplace. So he said what? If you're able to meet the social needs of workers, at the same time, improve how they interact, then basically, as a company, you're able to will perform better. Now, what were the key concepts in this theory? Now, we have two key concepts. Number one is that Mayo conducted the Hawthorne study. So his research was the topic of research was called what? Hawthorne's study on a Western electric company. He did research in 1924 to 1932. Now, which aimed to study the effect of what? Physical conditions on productivity. So that what? If you're able to improve physical conditions of the company, then we'll be able to what? As a company, we'll be able to what? Be more productive. That was his first concept. Number two, the results showed that social factors like feeling valued means if an employee feels like the company values them, feeling valued, and being part of the team, they feel like what? They play a part in the company goals. Being part of the team has a greater influence on productivity than physical conditions. Physical conditions is, for example, giving an employee like a modern laptop or a good laptop, having a good office environment. Is that what? The social needs of the employees, if you're able to take care of the social needs of the employees become very productive as opposed to what? These aesthetics of the office looking good, the desk and all those things. So what? Employees are social beings. So taking care of their social needs will make them more productive. Now, from these studies, what were his findings? The findings here that what? His findings were, number one, it emphasized on the Hawthorne's effect. Now, what is this Hawthorne's effect? So that workers' performance improved because they knew they were being observed and felt that management cared about them. So when you are observing employees in doing their work, if there's something that is something that makes them uncomfortable as a manager, you identify and then correct it. So that's number one. Number two is second findings was what? On the informal work groups. So social groups within the workplace strongly influence individual behavior. What are the social groups in your place of work? How can they help you to improve? So basically, the people you surround yourself with are able to make you more productive or less productive. Then number three, it talks about, his finding was what? Employee morale. So high morale increases productivity, low morale leads to what? Underperformance. So if you're able to improve the morale of your employees become more productive. But if their morale depends or goes down, then that employee will never be productive. Now, this theory, how can this theory now help us? We talk about implication for management. What? How does this theory help us in managing? Now you're a manager. If you read about 𝐿𝐻𝐈𝐍 or human theory, how can you apply it? Or what can you do to ensure that what? Your employees perform better? Number one is what? Managers should focus on employee welfare. Things like employee well-being. Things like issue of what? Talk about payments. Talk about the issue like ensure that your employees have got maybe insurance cover, health insurance cover, so that if they have a sick relative or a sick child, basically they are not disturbed financially. So ensure that they feel comfortable. Communication, always pass information, whether feedback, whether good or bad, ensure that employees get feedback. And then also group dynamic, ensure that what? You have a good formal grouping that is able to what? Help employees work better. Now, the second important is that encourage participation and teamwork to boost productivity. Ensure that each and every employee participates. There's nobody without any idea. We normally say that word. Sometimes when you're in a meeting, ensure that each and every employee bring their idea, whether good or bad. It depends that that idea can be reformed or this other can be refined to become a good idea. Always give your opinion. So those are what 𝐿𝐻𝐈𝐍 found out. I don't know if that was now understood. Is it understood now? Oh, Nelton Mayo, are we good? Good. Then let's go to the second theory here. The second theory is on somebody called Abraham Maslow. Just 1 minute, please. Now, the second theory is on Abraham Maslow. So there's this other theory is on Abraham Maslow. There's somebody called Abraham Maslow who is also did research on how to be able to motivate employees. So Abraham Maslow basically categorized needs. So let's look at the overview of what this thing called Abraham Maslow. So Abraham Maslow developed a theory of human motivation. So when Abraham Maslow was doing his research, he was looking at what? Human motivation based on the hierarchy of 5 needs that influence behavior and performance. So Abraham Maslow, what he did, before I explain the notes, Abraham Maslow came up with 5 classes of needs. And he said that an employee, the needs can be classified into 5. And he said that once a need has been satisfied, it is not a motivator anymore. That's what he said. For example, he said the first needs are called what? Physiological needs. There's food, water, and shelter. Once an employee has been able to get food, shelter, and water, food does not motivate them anymore. You have to move to the second category of needs. That's what he did. Now let's go one by one. Say that Abraham Maslow developed a theory of human motivation based on hierarchy of 5 needs that influence behavior. Means what? He was able to classify them as the first, second, third. He ranked them. That's what it's called a hierarchy. Hierarchy means what? From lower to, so there are lower level needs and there are higher level needs. So that's what Abraham Maslow needs. So his 5 levels of needs include, number 1 is physiological needs, which are also called what? Basic needs. Physiological needs, which are also called basic. So basic needs such as what? Food, water, and shelter. So his first category of need at the bottom of the pyramid is called what? Is called physiological. So means what? The first thing you need to give an employee, you must ensure that what employee has got food, has water, and shelter. That's the first thing that motivates employees. Now, once those physiological needs are satisfied, you cannot motivate employee by providing food and water again. Now you have to go to what? The second category of needs, which is called what? Safety needs. Now this one said that what? Employees need security, and security here we talk about 2. Number 1 is protection from harm. Employees need to be able to know that where we are working, we are protected. That is protection from harm. We are in a safe and secure work environment. At the same time, there's what's called what? Job security. We need also to ensure that what? Our employees feel like they are in a stable employment. Anytime you're given a 6-month contract, a 1-year contract, you are not very comfortable because you ask yourself, what if the contract ends? What happens to me? People who are in permanent employment, their mind is settled because they know that what? I'll do this work until I retire. So that's what so they say that what? Once you meet the basic need, now go to safety needs. Can you ensure that your employee feels secure where they're working? At the same time, they have a job security. So job security motivates employees. Then once you fill the safety needs, you have to move to the next level of needs, which is called what? the social needs. This one are needs that what? Employees are social beings. So basically, they want to feel a sense of belonging. Does this company value me? And that's why sometimes you find that even at workplace, people start forming issues like chama. Those ones are basically, we want to ensure that what? Our social needs are taken care of. We interact. Those ones are basically, when we talk about what? Issues of social needs. Very, very important that you look at them. Then talk about what? Friendship. Basically, in a work environment, we need to ensure that what? We are not only colleagues, we are also friends. So you need to create an environment where employees feel like what? They are also a family. Apart from being workmates, we should try to ensure that what? We increase it or we make it better so that when I look at a fellow employee, I look at them like what? My brother. So we must create friendship. Apart from professional friendship also, we must have sure that what? We go beyond what? The social circles. So that's on what? Friendship and also love. People need to be appreciated. The employees, sometimes you see some companies at the end of the year, they take people out, maybe for vacations, they give people vouchers. Those ones make them feel what? Loved and appreciated by what? By the members of the organization. Then once the social needs are taken care of, then we go to the second or the fourth needs, which are called what? Esteem needs. So this one means employees want to feel, these are basically feeling or being in a position of authority. That's what's called esteem needs. So recognition, people recognize your effort. People recognize you are the head of department, you are the manager, you are the head of, so basically those ones, recognition, respect. You command respect. People respect what you're doing. So basically, that one is another aspect, and also self-esteem. When you are, if, for example, in the office, you are given an independent office, you feel very important. You are HOD, you go to work. So basically, those aspects, recognition that you are the head of a department, even your office, sometimes you find that what? They have written something in your office of the HOD. Those ones are aspects of what? Esteem needs. People feel very important. They feel people give them respect, and that's what all call what? Esteem needs. And then the last needs is called self-actualization. And so this one, very few people reach here. Very few people reach here. This is basically, you talk about this where somebody said that what? I've done what God created me to do. I've achieved the highest level that I wanted to achieve as a human being. That is called what? Self-actualization. Realizing one's full potential and self-growth. For example, being a CEO of a given company, being a president, after being a president in a given country, what do you think? Maybe in that land, you have achieved the highest office. So basically, look at that. So those are called what? Hierarchy. Now, how does this theory help in motivating? So if today is Ipora, Maina, Knox, or any other person here, I employ any of you in my company, I must ask myself, this employee, which level is he in? Is he somebody who is still in the physiological needs or safety needs or social? So that I know what motivates you. Because if I give you a wrong motivation, or I give you a wrong, if I classify you in a wrong group, whatever I may think is going to motivate you will not motivate you anymore. You don't need food. You just need an office to feel motivated. You need to be given what? A position to feel. So basically, any employee that you employ, ask yourself, where are they in this hierarchy? So that when you know where they are, you can now try to provide for them what is next, what is in the next hierarchy for them to feel motivated. But in all these aspects, money is a motivator, whether in the physical needs or safety. As you go up the ladder, money is a uniform motivator in all those levels. I've seen a question here. Yes. What they were doing is, these are basically separate researchers, but they were looking at separate areas. So Mayo was looking at what? How you are able to what? Improve social aspect, or how social aspect improve employees' motivation. But now Maslow was looking at how the needs, or he classified the needs, so that to say that what, for you to motivate an employee, you must know where are you? Are you in the physiological needs level? Are you in the safety needs? Are you in the social? So that what, we know what motivates you. If you have food in your house, good, any food you want, and I come and give you food, food will not motivate you. So I look at what is next. What doesn't this employee have that when I give them, they feel motivated in this job? So this is what Abram. So if you're a manager, given employee, a given company, ask yourself, these employees I have, which is their level of need? Where are they? Now, what can I do to motivate them so that I don't do something that they don't feel is a motivation anymore? Are we together? Up that point, all of you, are we good in whatever I've tried to explain? Yes? Is that point understood? Yes, so Abraham Maslow categorized needs into five. He categorized needs into 5 categories. Yeah, he had 5 categories. Florence and Muti has responded. The rest? Zipporah, Maina Knox. Are we good? Ismail, yes, we're good. Now, from that explanation, we need to look at the key principle in this theory. What are the key principles that every manager should look like? I'm highlighting in yellow so that you know where we are. I like highlighting, so I'm highlighting in yellow. So we are in where I'm highlighting in yellow. Now, that key principle: needs must be satisfied in a hierarchical order, starting from the most basic. So according to Abraham Maslow, we must be able to what? Satisfy needs in that order, starting from the basic. That means food, clothing, and shelter, which you call what? Physiological needs. Then you move up. That's why you find that sometimes, I don't know if you've seen it. If you walk in the streets of Nairobi and you see these street kids and those street families, you see them sleeping in the open, under a tree, under the bridge, or under the in front of the shops, and they sleep very comfortably. Sometimes you even move at around 7, or on weekends when people don't open, some shops don't open, you find them at around 7, they are still asleep. And you ask yourself, how do they feel so comfortable? You see, those kind of people, what matters to them is food. If you're able to give them food, they don't care about any other thing. If your stomach is empty, you don't even think about security, you think about food first. Once you are full, is when you say, "Ai, kumbe niko mali insecure." Say, "Ai, niko wapi?" Because you are full. That's why even sometimes when people get jobs, mtu alikuwa naishi maybe in one of the informal settlements, alafu akapata kazi, you see them wanaanza to move out of the place. Why? Because now they feel like in this place, if I buy my 24-inch TV, I feel insecure here. If I buy, so basically those ones are natural happenings. Even your friends, let me tell you something about even friends. Some of your friends, once they get good jobs, they'll stop being your friends. And don't be offended. Sometimes that is how nature is. So that I knew this guy when he was here, now he's gone to some place, now he's the CEO, he cannot even say hi to me. That is how nature works. A few of them will remember you. Some of them may have another social circle. That's how life is. So don't feel offended that somebody was your friend and then now. So yeah, we've gone to some of our friends' offices whereby we are told by security to book what? Come and book appointments. And this somebody I know, my friend, we used to know, we hustled together. Then now, has been told that what? You can only see him on Friday at 2. Now look at that. So basically, those are things that how life is. Then once a lower level need, I mean the second point, once a lower level need is met, the individual seeks to satisfy what? The next level. So needs, that's why you first satisfy the physiological need, then you go to what? Safety needs as you move up. And then number 3 is what? Unsatisfied needs motivates behavior, while satisfied needs do not. So I'm motivated to achieve the needs that I've not yet achieved. Whatever I've achieved will not motivate me anymore. If you finish CPA, CPA doesn't become about an academic motivator anymore. You look for something else to do. Whatever you've achieved does not motivate you anymore. You want to achieve something new. That's what they're saying. So that unsatisfied needs motivates. You want to do your master's, you want to do your PhD. That one motivates you. You want to do your undergraduate, motivates you. But if you've done a course, it doesn't become a motivator anymore. You want to move up to the next. That's what he's saying there. So once a lower need has been satisfied, it doesn't motivate anymore. So if you have food, if giving you food does not motivate you, no, you need me to what? Give you a position to become now what? Head of section or head of the department. Now, then let's look at implication of this need. What is the implication? For example, if you're a manager, you want to apply this, how can it help you? How can this basically theory help you as a manager? So there's one that I've highlighted in green, we're in there. So one is what? Managers should identify the level of needs their employees are at and create what? Work environment what? Fulfill those needs. I must know where you are. Are you at the physiological level, safety level, or whichever? Then what? I know what to do to motivate you. You may have 3 employees. Each one of them, different things motivates them. And what motivates employee A may not motivate employee B. But what I know is that money is a common motivator, unless somebody convinces me. Even the people in the higher hierarchies still need money. Give them office and money. Make them a CEO and give them more money. They're going to be very satisfied. Then, number 2, provide job security. Ensure that what? Employees feel secure. Job security, team collaboration, recognition, and opportunity for what? Personal growth, enhance employee motivation and performance. So all those aspects talk about job security, collaboration, recognition, and opportunity for what? Personal growth. I must see an opportunity whereby today I'm at lower level. Once I finish my CPM or CPK, I should see how I can be able to move up the ladder or be able to what? Get other chances here. So that is called all on Abraham Maslow hierarchy of needs theory. Are we good on that theory? Is the theory well understood? Is the theory well understood, ladies and gentlemen? Mutie is saying yes. The rest, JK is saying yes. Let's interact. Let's interact. If you have a question, you ask. If you don't have a question, you just say yes, and then we proceed. Because I like being a response, because somebody may be still constructing a question. So if I go ahead, so that's why when you respond by just writing why or yes, we feel good that we are good, then we can proceed. Now, the next theory was done by somebody called McGregor. Now, anytime I read this theory, I wonder, where are Africans here? Africans, when these guys were doing this theory, we are still migrating, or what happens? Was there any African who was able to just sit down and come up with a theory? It's a challenge. We must do theories. Next time, ensure that we'll have a minor theory, an Ishmael theory, or a Zipporah, or maybe what? Florence theory. Ensure that you do something that your theory can be read in books. Now, let's look at McGregor theory X and theory Y. So McGregor classified employees into 2. There's a question by Florence here. Say that, Mwalimu, I have a question. I have 2 employees. One is loved by the people and not productive, while others is not loved and very productive and does her work well. Kati yawa, who should I promote? Florence, professional relationship and personal relationship are different. What at work environment is about productivity, nothing else. Not about being friend, carrying for me tea, or doing ABCD. At the work environment is about productivity. If you're my best friend and you're not productive, we drop you like a hot porridge now. There's nothing like being loved. At the work environment is about productivity, nothing else. So if you want to promote the one you don't like but very productive. Because if you're a manager, that employee's productivity contributes to your performance. If you are the head of department, the performance of your juniors determines your performance. So if you put somebody because he's a social friend and then they're not productive, you are also going to fail. So retain the person that is not your friend but very productive, and fire your friend who is not productive. Just tell them that, my friend, you know you're my friend. And I'm going to be honest with you. In the social aspect, you're wonderful. In the professional aspect, you're poor. So let me fire you. We are going to be still friends outside there, but let me retain somebody who's able to what? Help the company achieve its objective. You fire them when smiling. Let them go. If it's about promotion, tell your friend that you make me happy here. You are very social. But you cannot be a head of department if you've not proven yourself that what? You're productive at this lower level. So promote the person doing the job. I don't know if there's anybody agreeing with me. At the job environment, there's nothing like being loved. It's about productivity. Anybody who is supporting my argument, somebody who is disagreeing with me, promote the most productive, leave alone relationships. Those ones are after the office, after passing the gate, your friend. That's how it's supposed to be, Florence. There's something called merit. Let meritocracy prevail. Even if somebody is your brother and they're not productive, fire them today. Go home in the family meeting and support what you did. Some of them may curse you, but in that family meeting, let them know that this was my brother. I love him so much. That's why I did not want to put him in a level of authority because he's going to embarrass himself. That's why I fired him to come home and do farming. And if your family members are people who are good, they want to say that you have done a good job because you didn't embarrass our family by putting him at the helm and then you bring the company down. So sometimes you tell your friends the truth that you're my friend, good socially, we interact a lot, but in terms of productivity, you are letting me down. So in case any promotion comes, basically, that's why sometimes I have a problem with those who mix personal relations with professional. There's also somebody who could be your friend at the same time very productive. That's now a good one. But nobody should not hang on the social interaction or connection to get promotions. That one is a no for me. Even your children, train them to know that things are acquired on merit. So that if you don't acquire it on merit, well and good, but tell them that what? Anything that they get in this world is about productivity. Can you be able to what? Do something of value? That's what it's supposed to be. Good. I think, Florence, you are answered. So, huyo mwingine mwambie tu wewe rafiki yangu, if it comes even to do downsizing, you will go. So utaenda nyumbani tu. You're my friend, but if a chance comes for downsizing that we need to reduce employees, you are going to go. If you don't change, my friend, you will go. And I'll sign your letter, dismissal letter, then I'll wish you well, but we'll keep interact outside there. Now, let's look at what McGregor did. So Douglas McGregor proposed two contrasting views about workers, which he called theory X and theory Y. So this McGregor said that in any company, you people are working somewhere, we can group those employees into two categories. We have the theory X employees and theory Y X employees. Now, let's look at theory X. What do you say about theory X, which are called what? We call them, in theory X, if you're a leader, you must go for what's called what? Authoritarian style. If you are managing employee who belongs to theory X, you must be a dictator. These ones are people that don't listen. These people don't like work. So if you're going to manage in your company, if you have theory X employees, apply dictatorial what? Management style. So say that word. This theory assumes that workers don't dislike work. They don't like working. They avoid responsibility. They require close provision and are motivated by money and threats. You cannot be a manager who threatens employees if you're not a dictator. So these employees every time tell them that, you will fire you. You are not doing. If you don't do that work by Friday, I'll do a warning letter. So that means what? Because if you look at these guys, number one, they are lazy. They don't like working. They don't like work. Number two, they avoid responsibility. Who is going to do this one? All of them are. They now, everybody disappears. And then they require, if you're not in the office, you see everybody now say that, oh, we are now free today. We'll do work when the manager comes. So number one is what? They require close. If you're not there, if you just jump out for lunch, you find things are in chaos. Then the only motivation they know is what? Money. When they tell them that you want to give them money, now they work very hard. And also threats. I don't see you taking 2 months in this company. The way you're behaving, those one now they start behaving. So managers using this approach tend to be controlling and strict. You're very strict. Time. This one, you know, you sit down and look at time. So you're very strict on them. So that's called what? Theory X. So in every company, we must have Theory X employees. Then we also have what's called what? Theory Y. Now, Theory Y, if you want to manage them, apply what's called what? Participative management style. Now, what are the features of this? Let me use a different color to explain this Theory Y. Employees. I'm using. I think that is blue. Eh? So Theory Y, assume that workers are, number one, it's what? They enjoy work. That means what? Theory X are basically direct opposite of Theory Y. These workers, number one, they enjoy work. Number two, are self-motivated and responsible. Means even if you're not there as a manager, these guys will come to work, do their work as if you are there. They are self-motivated and what? Responsible. Number three, they seek opportunity to grow. Means any opportunity they see that can make them grow, they seek it. If about going to school, they go to school. If about going for some seminar training, they seek those. They ask you, sir, can you be able to help me do this one? If they want to go to school, they let you know. So we call them what? We call them, they seek going to grow. Means what? They are always very curious. They want to ensure that what? They grow. And then can be creative and innovative. These guys are very creative. They are very creative. They try to come up with better ways of doing things. They don't want to do things the way the others do. They want to become a better way of doing. So they're very what? They can be very creative and very innovative, these employees. Now, here, use what's called what? Participative style. Now, in every employee, in every company we are in, we must find these people. I know even where you're working, there must be these characters here. Actually, this Theory X, there's always one person. A company must have a representative of these people in every company, even where you're working. And ask yourself, do also self-assessment. Are you the one? Are you one? You can also be a Theory X person as an individual. Do what's called self-assessment. Number one, do you like work or you work? You don't like work. Do you take responsibility or you avoid responsibility? So basically, we have Theory X and Theory Y in this company. Now, what are the key differences between these theories? What are the major differences, or what are the key differences between these theories? So that Theory X sees people as lazy and untrustworthy. So anybody you see an employee, you say these are lazy bones. You cannot trust them, and they require control. Requiring control is what makes them, now you apply what's called what? A dictatorial leadership style. You become a dictator. You must ensure that word. You tell them that word. They have to do things by force. Now, Theory X sees people as capable, means people or employees can stand on their own. They see them as capable, employees as capable, and self-directed, means these guys will work whether you're not there. Thriving in environmental of trust. You trust these employees that you can leave for them work to do and go somewhere and come back and find that what? They have done the work in a proper manner, or they have done the work properly. That is on what? On Theory Y. Now, what is the implication of this theory? If you're a manager and you read about this theory, how can you apply it? Or what is the implication of this theory? So we are in the implication, the one that have been able to highlight in, I've been able to highlight it in what? In blue. No, this is blue. Yeah, blue, yes. See that theory, Theory Y is more aligned with modern management thinking and encourage employees' involvement, delegation, and development. So in a modern company, you must, or you should have what? Theory Y. A modern employee should be self-motivated, trustworthy, somebody who seeks motivation, seeks what? Responsibility. Now, manager should empower employees. So empower your employees. Ensure that your employees are empowered. Empower your employees. Should empower employees. Provide meaningful work. Ensure that you give them work that basically challenges them, and encourage what? Participative decision making. Ensure that what? Your workers are also they participate in decision making, that or what? In the decision making. So ensure that what? Your workers become part of what? Part of decision making. So involve them. Ensure that you call them. You can be able to what? You can be able to basically involve them in decision making. That is very, very, very important that you look into that. So that is on then McGregor's Theory X and Theory Y. Any question on McGregor theory, X and Y or Y? Any question on McGregor's theory X, theory Y? Any question on McGregor's theory X, theory Y? Yes, we are good. Your theory in Kosawa. All of us have understood the theory well. Then we go to another theory done by, at least now we have gender balance here. There's also a lady who did a very good work and was able to what? Come up with a theory. This is called Mary Parker-Fallett's management theory. So there's also a lady who did a very good research and has been able to what? Able to basically come up with a theory that we are now learning. Now we say that Mary Parker-Fallett is considered a pioneer in the field of organization behavior. Means what? They were the first people. Pioneer means what? They were first people who did research on the area of what? Of organization behavior. They did a research on the area of what? On the area of organization behavior. They did a research on the area of organization behavior. Did a research on that area. So a pioneer means what? They were the first people that did research on that area. The first people that did research on that area. Just a minute. Now, so she emphasized the importance of human interaction. So he said that what? Human interaction is very, very important. So she emphasized on the area of human interaction, also on the area of collaboration and conflict resolution in management. So he said that number one, you must ensure that what? There's good interaction between or among you. There's collaboration between management and employees and between employees themselves. And there's an amicable way of resolving conflict. Anytime you have a place where there's more than one person, there's bound to be conflicts. Now, he said that what? There must be a better way to what? Resolve conflict. Now, what are the key concepts in his research? So I'm highlighting in yellow, you can see. Number one, the first key concept, he said that there's something called power with, not power over. So that if you're a leader, you should work to ensure that what? You cooperate with the juniors. You should apply power with, not power over. There's no employee you have power over that have power over you. No, you have authority over them, but not power over them. You can only have authority over an employee and not power over them. So you apply what's called what? Power with, so that you work as a team to achieve. So leadership should not be about, leadership should be about cooperation and mutual respect, not control and domination. Respect. However junior an employee is in the workplace, give them the respect they deserve. Don't ever disrespect an employee because of the level they are in. Even somebody who is cleaning your office, even the security guard at the gate, give them due respect. We are all human. And sometimes the position we are holding is out of the privilege and maybe the favor of God. So we should not abuse them by making those who are doing junior or lower jobs feel like they're less of a human being. Because we need them. Imagine a situation whereby you don't have security guards, you don't have cleaners. How will the environment look like? So basically, everybody fits well where they are. So respect their jobs and their responsibilities. So should what? Should ensure that there's mutual respect, not control and domination. Number two, integration. Conflict should be suppressed and compromised. No, conflict should not be suppressed or compromised, but resolved through integration, a win-win solution. So if there's a conflict in a given company, don't cover that conflict. Open it wide, let's discuss and resolve it amicably. Avoid cases whereby any conflict you put them under the carpet. One day it's going to explode. Ensure that what? Every conflict that comes, we open it wide. The parties involved are called. We resolve the conflict amicably so that when everybody goes home, they know that what? The conflict was resolved. I mean, everybody, when we resolve the conflict, we have what's called what? A win-win situation. Everybody feel like what? They have won. Not a case where somebody feel like what? This thing was resolved and the other party went with what? A bigger percentage of what? Of a win. Then we also talk about number three, about group influence. So groups and teams are essential for problem solving and decision making. Groups and teams are essential for problem solving and decision. So ensure that what? Every time you do something, involve the group, discuss with people, call meetings, so that you see that what? This was a departmental decision, not an individual decision. So try as much as possible to involve others, so that when people fail, we fail as a team. When people succeed, as a team. But a case where you want to take all credit, then basically you are not a team leader. You are not a team player. You are an individual. That's why even if a company performs better and you're the CEO, or if your department performs better, you are the HOD or the CEO, always appreciate the efforts of the juniors in helping you what? Become the best CEO or the best head or the best performing department. Don't take credit for it. Everybody had a contribution to do. Then the last one is leadership. So managers should act as facilitators rather than what? Dictators. Promoting shared goals and participation. As a manager, don't be a dictator. Although in management, you should be able to flip or do what's called what? Keep on changing management style. There are times when you bring a little bit of dictatorship. There are times when you bring collaboration. There are times when you bring participative. There are times when you bring democratic. There are times when you bring laissez-faire, free reign. So basically, as a manager, don't be so predictable. Let your employees start guessing how will you act, and that one puts them on top. But there are cases where people say, so and so has been promoted. We are now free to do whatever you want. So basically, be somebody who tries to make it, you mystify, you make people believe how I want to act. So sometimes just mystify leadership. Sometimes act very weirdly and people believe that, hey, is this really Zipporah we know? There is not, so that people know that there are times when you change how things are supposed to be done. There are times you're very friendly, but there are times when need things to be done, you're also very tough. Tough doesn't mean you are arrogant. Tough means what? You just need things to be done at the right time. And sometimes there's something called, you must be assertive, not rude. Assertive means what? You mean what you say. We say that this thing should be done by Friday at 1. That Friday at 1, I should see it here. If you don't bring it by that time, then basically we need to take what? A disciplinary action against you. So sometimes as employees also, let's not just blame managers. The heat that comes from the top is also very high. And if you're not able to help the manager manage or help the manager in such a way that they're able to do things the right manner, sometimes those managers the heat will come down. That's what happens. When you see your HOD is putting pressure on you, know that the heat is coming from above. He or she is also finding what? A way to disperse the heat. This is too much. There's a target, the departmental target, there's a branch target, and there's a company target. The CEO wants to see the company target being achieved. They ask the people junior, what are you doing, Bana? We are beyond target. The person also escalate down until the junior most person. So when you see the heat coming from up, means what? Everybody is just trying to trickle it down. So when I'm the HOD and there's a pressure on me, I also put pressure on you. You also put pressure on what? Those who are your juniors. That's how it happens in a company. Those who are in management here know that there are times when the moods in the office are not good. Things are not working. So those ones are some of what. So you must be able to what? Fine. But at the end of the time, you must know that what? You're dealing with human beings. And a human being is the most difficult resource to deal with. We call it human resource. This is the only resource that has a brain that thinks. So dealing with them requires some aspect of what? Intellect. Don't deal with human beings the way you deal with machines. Human beings are employees who are intelligent. There are people who are intelligent. And sometimes if you're not careful, some of them may even lead to what? You going home if you're not very careful. Now, that is on what? On the modern, on the those theories. Now, we want to go to the last bit. We call them what? Modern management theories. So there are people that have developed. So we have modern management theories. These other theories were not very modern. The classical theories, the behavioral theories, they are not so modern. Now, the modern theories are called what? We call them, we want to look at what? Some of the modern theories. And some of these modern theories, they're just improvement on those theories. Now, on the Mary-Parker-Follett theory, any question? On the Mary-Parker-Follett theory? On the Mary-Parker-Follett theory, any question? Before we go to the modern management theories? On the Mary-Parker-Follett theory, any question? Mutier is good. 𝐿𝐻 has no question. JK has no question. So I think we are good. All of us are good. So thank you very much. I've seen people saying they're good. Now, let's go to the modern theories. We want to talk about the modern theories that we have. I don't know, or can I give you a 5 minutes break? Can you have a 5 minutes break? If people take a glass of water before we proceed? Any break? So let me give you a 5 minutes break so that at least some of you can take a glass of water before we can come back. So let's have a small. Lawrence, that is a very important activity. So we're going to give a 10 minutes break. We are at 1:20. By 1:30, let's be here. Let's give Florence also, one of us, a chance to ensure that other people also get their lunch. So let's have we'll be here at exactly 1:30. So let's have a small break, then we come back. The break was supposed to be a small break, and I believe that everybody is back. Confirm if you're back. The break, we're done with the break now. Confirm you being available now. Confirm if you're back. JK is back. Maina is back. Confirm. 2 people are back. Wanga, Joy is back. Ishmael is back. CPA Guru is back. Florence, where are you? Good. I think more than half are back, so we can proceed. Good. Thank you very much. Now, I want us to move to modern management theory. We have looked at some of the theories, and those theories basically, they are quite traditional. So I want us to look at some of the modern theories that are being applied in the modern. We're not saying that those theories cannot be applied. Classical behavioral theories, they can still be applied, but in the modern way, we have theories that are more effective in carrying out our management function. Now, just to introduce say that modern management theories have evolved to address the complex and dynamic challenges faced by the organizations today. So it means what? These are theories that are current. So they are brought about to be able to address the current challenges that you're facing, because the companies nowadays are working in a very dynamic and challenging environments, or dynamic and very challenging environments in terms of competition. So there needs to be modern theories to address those issues. So these theories focus on using scientific approaches, understanding organizational interdependence, and adapting to changing environment. Means for you to manage a modern company, you must keep on changing the modern environment of applying the what. So then let's look at some of these theories one by one. We are talking about these are just theories that are what are nowadays being applied. So they depend on what? Scientific research. So let's look at some of these theories that we have. So the first modern management theory we're going to look at is called the quantitative thinking. And this one, you find that this one dwells more on a lot of research and statistics. Now let's define quantitative, not qualitative, but quantitative. Let's define this quantitative theory. So is that quantitative thinking or theory is that quantitative thinking in management refers to the application of mathematical, statistical, and computational tools, decision making, planning, and problem solving in organization. So this basically, they apply some statistical frameworks to be able to what? Make a decision. If, for example, you want to expand to another country, you use a statistical formula to determine or to help you make a good decision on whether to basically expand to a foreign country or not. You can also apply some of these mathematical or statistical methods to know how to improve your productivity in future. Now, what are the key concepts of this theory? What are the key concepts which are applied in this theory? Number one is operational research. And this is a very important area in the modern management. Talk about operational research, OR. So that uses mathematical models to analyze complex problems and optimize resource allocation. So let's say, for example, budgeting. You know that resources are normally very scarce, especially financial resource. Now, you can use operational research to help you determine how to allocate the few and scarce resources optimally to ensure that the company operates or achieve its objectives. Another concept is statistical analysis. So how is this one applied? The second one is statistical analysis that uses data analysis to inform decisions, e.g. forecasting. For example, if you want to forecast, if you want to predict demand of a given item that you use, then look at the historical data. What has been the demand of this product from the year 2020 up now? So from the previous quantity used, you can predict the future. So you can apply a time series analysis or any other statistical formula to help you project what the need may be or the demand in future. Then the next one is the queuing theory. Very important. This one is nowadays being used in various. We have the queuing theory. So managers customer service systems like banks, call centers, or hospital. There's something called a queuing theory. I don't know. There's some place whereby when you call, for example, when you call customer service, you're told that you are caller number 12. There are 9 people ahead of you. So you wait until your turn is reached. If you go to the bank today, banking hall, where you want to pay your school fees through the bank, now you find that there are so many people. So you go and pick a ticket, and that ticket tells you your customer number and how many people that are ahead of you. So that if you find that maybe there are 30 people ahead of you, you can go and do something in town and come back and get served because you have the ticket. So because your ticket will be called, those are called queuing theory. Even hospitals, people go and they're given numbers and then they're served as per they go and pick tickets. So that will help to ensure that aspect of so that I don't have to be on the line for 5 hours. If I know that I'm going to be served at 4, then I can go do something and then come back with my ticket at 4 and be served. Then we also have another one called linear programming. So it solves problems related to maximum profit or minimizing cost. So you can also use a statistical linear programming technique to determine how you can be able to get maximum profits or minimize costs. So basically, there are those statistical aspects. So this is based scientific. Everything you do, you apply some statistics, some mathematical models to ensure that they help make it. So basically, the outcome or the solutions of those models are what used to make decisions. That's how modern companies are being run. Now, what's the application of this quantitative approach? Where is it applied? What are the areas where this approach is basically being applied? So we say that it's being applied in scheduling production or workforce. You can use the queuing theory to what? Schedule that this one comes first, second, or workforce. If you're working, we have what's called a 24-hour economy, and we are working 8 hours a day, then basically we can use these formulas to what? To be able to what? To be able to allocate employees so that what? In 24 hours, we have somebody working in the office. Then also, in inventory systems, you can apply this in inventory whereby you receive stock, first come, first serve, or when you're selling, there's something called FIFO and LIFO. First in, first out, and last in, first out. So basically, you can apply this quantitative thinking in what? Then what? Financial planning and budgeting. Some of them might help you do financial planning. So you can use some of these statistical formulas or mathematical formulas, or some of these queuing theory help you in basically budgeting. And then supply chain and logistic optimization. Like for example, you realize that even some of these big circles with so many vehicles, they have these formulas. So when there's, for example, when there are more, let's say for example, the one that the company is seeing with a lot of vehicles are, let's say, Super Metro. I use that one as an example. Now, Super Metro has got a fleet of cars. I think more than of vehicles, more than maybe 100. Maybe they could be in the tune of 200 or whichever, but let's use 100. Now, there are times when there's demand for passengers demand on a particular area. Maybe let's say, for example, there's a football match going to be done in Kasarani. Means what? There'll be more flow towards Kasarani. So basically, you can be able to use this mathematical formula to know how many fleet of vehicles or how many vehicles do what? Allocate to take care of because of what? Of the demand in those areas. So those ones are cost. Now, then what are the advantages of this technique or this model? The first one is that improved decision making through data and model. So every time you make a decision using this model, this techniques, you're able to back up. If somebody asks you, why did you put this amount of money in this department? You say that what? I used this statistical model, and from the findings, it's what outcome. So I allocate the based on what? On this scientific proof. Nobody can. Then enhance efficiency and productivity. You become more efficient. And then last one, reduces uncertainty in managerial choices. There are times when as a manager, you don't know what to do. So if you're able to find a mathematical formula or a statistical formula that's able to help you, then basically you depend on. Sometimes you don't know what to do. You are at a crossroads. Then you say, okay, someone said, we have this model that can help you what? Make the right choice. So basically, they reduce what? Uncertainty, whereby you make scientific decision. Now, then you have limitations. There are people that are also against this quantitative thinking. And their reasons are number one of the challenges or one of the reasons why some people don't apply this one is number one, over-reliance on numbers may overlook what? Human and behavioral aspect. So if you depend so much on calculations, data, you will fail to understand the human aspect or the human bit of how people are. So we don't just depend on numbers. Sometimes there's an aspect of what? Of human interaction, relation to what you're doing. So that is something that this theory may overlook. It may overlook what? The human factor. This theory may basically overlook the human factor in terms of what? In terms of decision making. That is why we say that what? That's one of the challenges. Number two is require accurate data and skilled personnel. We see the one using statistics. So it requires what we call data. Anytime you're using a model to do calculations, then basically you must give in what? Good data, because that model is going to analyze the given information. So if you key in wrong data in SPSS, you're going to get wrong feedback. So we must ensure number one, make sure that that data we're putting in these systems are very accurate. That would help us make the right decision. And then last one, models may oversimplify real-world complexity. So some of these mathematical formulas may make findings very easy, but it's not easy in the natural setup, because natural setup, you find other factors, economic factors. Talk about legal factors. So there are other factors that are under play that may affect decisions. But with this one, you depend on mathematical calculation. So sometimes it may overlook other real-time factors. Talk about technology, talk about political environment, talk about economic environment, talk about social. So basically, it doesn't look at what? The other aspect. You look at only the what? Statistics. That is on what? The first one called quantitative thinking. Anybody with a question on the quantitative thinking? Any question? Any question on the quantitative thinking? Any question? Can I assume you are good? We proceed. Hello? Zippo don't have a question. Zippy doesn't have a question. Lawrence, yes. JK, yes. Ismail, no question. So we are good. So that means we are free to proceed. Let's proceed and look at the second modern theory. And the second modern theory is, just a minute. The second modern theory is called the systems thinking. Now, what is this systems thinking and how does it apply? So we start by defining what is this systems thinking and how does it apply. So see that systems thinking views an organization, systems thinking views an organization as a system, a set of interrelated and interdependent parts working towards a common goal. This approach emphasizes holism, integration, and the interconnectedness of subsystems within nations. And so basically, what this systems theory talks about in short is that a company is like a system. Let's talk about, for example, breathing system, digestive system, is a group of interconnected organs or aspects. Now, a company is made up of semi-independent sections called departments or branches. All of them work to help the company achieve their objective. So basically, they're part of the system. So there's what the breathing system now. For example, me as human beings, we have the breathing system, digestive system, and other systems. And those systems help us to survive or help us to be alive. So the company also has got system. The accounting system for the accounting department, HR system, HR department, the production system. So basically, all these ones are part of the company. They help ensure that the company achieve its objective. Now, what are the key concepts in this approach or in this thinking? So that the first one is what? It's an open. The first concept is open system. What does it mean? So we say that organizations interact with the external environment, customers, suppliers, laws, and so basically, the company or organization normally interact with various environmental factors. The company interact with number one, customers, which are outside or external partners. The company interacts with suppliers. The company interacts with the law, the rules and regulations that govern operations of a company. They interact with the law. The company interacts with technology. So basically, those are external factors, but they help the company what? In achieving its objective. We call them what? They are external factors that help the company achieve its objectives. So we cannot work in isolation. We have to ensure that what? We embrace them. Number two is input, process, output, and feedback. So there are things that happen. And a company must have an input. There must be a time when the company, there must be an input. And then a company must also have a process. Once input come, maybe raw materials, they come to the company, they are processed. When they are processed, we have the finished product, which is the output. And that output is supposed to go to the customers, and then the customers give us feedback. So you say that a company has got what? Those three systems. It has got the inputs, it has got the process, it has got the output, and the feedback. Well, let's say, for example, we pick raw materials, which is the input, we process them, then you have the output finished products, we sell to customers. Customers give us output. So whether it's a service or a good, we have to go through that process. So that input resources are transformed through process to produce output, product, and services, which feed with the feedback influencing future operation. So the feedback we get from the customer determines the future operation. That's basically what you're saying there. Then we also have what we call a subsystem. Subsystems are departments or units. Talk about HR, marketing. So these are basically, we call them subsystems, like departments. Each of those departments, they are semi-autonomous, means they're semi-independent, but basically they depend on one another. For them to say that we have a company means a company is basically a collection of those departments, a collection of employees, departments, and branches. That's what makes a company. So that's what we say, that a company is like a system. Now, what is the application? Let's look at the application of this systems approach. It's applied in number one, strategic planning. When you want to plan strategically, strategic planning basically means what? You plan for the future. Then basically look at a company as a system and know that what? Each part of the system plays a crucial role in the company. That's number one. Number two is change management. If you want to implement a change, look at all aspects of the company and try to find out how can you be able to what? Help in implement a change. The number three is what? Is organizational development. If you want to develop a company, ensure that the communication touches all the parts of the company, so that the company system, everybody must know, whether the branch, the department, the section, all of them must have the information on what you want to do to ensure that the company develops. And then environmental scanning and adaptation. Sometimes when you want to operate as a company, you don't operate, a company does not operate in a vacuum. A company operates in an environment which has got both internal factors like employees, management structure, and those ones, and also in relation to what? External environment. Talk about political environment, economic environment, technological environment. So we call them the PESTEL: political environment, economic environment, social environment, technological environment, ecological environment, and also what? Legal. So basically, as a company, anything you want to make a decision, look at what? All those aspects. Now, what are the advantages of this systems theory or systems approach to management? What are the advantages? Number one is that what? It promotes a holistic view of the organizational plan. It means what? You look at a company as a body having several systems. So it helps you to understand the company. Anytime you look at a company as a system, then basically you understand what happens and the importance of every sector of the company. Number two is what? Enhances adaptability and long-term planning. Means if you look at a company as a system or holistically, then basically you can know how to adapt the prevailing environmental factor. At the same time, you're able to ensure that what you can plan long-term because you know what is needed and what's there. Then encourages what? Interdepartmental collaboration. As a department, you cannot operate in isolation. You must collaborate with other departments. So it's like, for example, the head cannot be there without the neck. The hands are there, the eyes, the nose. So basically, that's what happens. As a department, you are semi-autonomous. Means what? You are semi-independent. You cannot be fully independent. That's what happens. Now, what are the limitations of this theory? Some people are against this systems approach, and they say that what? These are the reasons. So what are some of the problems or the limitations? Number one is what? Complex to implement and manage. It is very difficult to understand your company in totality. And applying this system requires expert, and sometimes you need what? A consultant. So it's not easy. Number two, difficult to analyze the impact of each subsystem. It sometimes can be difficult to know the contribution of each system can be difficult. And then maybe challenging to pinpoint accountability. Very difficult to be able to what? Do what we call what? Apportion accountability aspects. Who did wrong? So sometimes it's difficult to trace, especially if you have a big company. These multinational companies can be very difficult for you to what? To be able to check on this aspect or understand this aspect. So that is what's called what? The systems approach or systems theory. Is it understood? Is the systems theory understood or understood? Any question? Is the systems theory well understood? People are quiet. Hello? Are we in class? Now I'm starting to call name by name. CPA Guru, Florence, Ismail, JK. This class, we say that in my class, you have to interact. I must see you writing at the chat forum so that I know you are present. At the same time, it helps you to be able to what? Be like, so I need to see, if I see you in class and then I don't see you interacting, then basically I assume you're not getting what I'm saying. So always try to interact with the chat forum so that I know we are together. Now, so I've not seen anybody asking a question. So let's go to the last one, which is called what? Contingency thinking. This is the last bit. So let's look at this also, one of the modern management theories. You talk about contingency means what? You try to ensure that what? You look at put measures in place to ensure that what you're able to, in case of any emergency, you're able to what? Have a way of managing. So contingency thinking accepts that there is no one best way to manage an organization. Instead, the most effective management style structure organization depends on the various contingency factors like what? Environment, technology, size, and culture. Means what? They say that what? There's no one best way to manage a company. How you manage a company depends on environment you are in, technology, size, and the culture. And that's very true. You cannot copy-paste somebody's management style and go and put in yours because there are a lot of things that are different. The resources you have are different from them. So basically, try to find a way in which what you're able to look at. So manage your company subject to what? Factors that you have. Now, what are the key points here? The key points are two here. The first key points are two here. Number one is what? Fit or alignment. So managers' practice must align with the context. How you manage your company must what? Align with the context which your company is, where you operate as a company, the size, the structure, the environment, basically determines what you look at. Thank you very much. That is very true, Zipporah. That's what. So Zipporah has just added that just to add on systems, functions according to the strategies are terms as open systems, environmental dependence, and environmental serving. So basically, you manage your company subject to what is happening. Don't copy paste. There are other management that they're universal, but basically how you apply them depends on what? On the company that on how you on the environment you operate in. So the key concept, and number one is fit for alignment. So management practice what? Must align with the content. So your management practice must align with what you want to achieve. Number two is what? Situational variables. So internal resources and external competition laws, condition influence what? So what they're saying is that what? Different situations determine the decision you make. There could be resources, there could be goals, there could be competition and the laws. The situations that are inside or outside the company can affect how you what you do. And then adaptive management. So leaders must be flexible and responsiveness. Don't have a rigid management structure. Ensure that what you are able to be flexible. The world is changing very, very fast. Things are changing. So as a manager, don't be very rigid. Embrace new things that are able to what? Help your company become what? More competitive. So that's called what? Adaptive management. Look at that and check on it very, very well. Then application. Where do we apply this contingency approach to management? How do we apply it? So we apply it, number one, is choosing between autocratic and democratic leadership style based on the employee skill level. So the nature of the employees you have will determine the leadership style you apply, whether you become autocratic, a dictator, democratic, or transformational. So basically, the nature, how your employees are determines how much you manage. Then number two is what? Structuring company. So centralized, depending on what the size. So basically, there's something called organizational structure. We can manage the company in two ways. We can centralize or decentralize. Centralized means what? You have like one head office, which decisions are made at the head office. But decentralized means what? You can now make decisions at the unit level, maybe departmental level or the branch level. For example, before constitution, before we had the new constitution, we used to have what's called what? National government running everything. But now, after constitution, new constitution, now we have counties. Counties are decentralized government operations. We have national government. So the decision that can make at the county level, so we call them what? Decentralized. So power has been decentralized. Now, then designing motivation strategies suitable for different. So basically, I say that what? Each employee will be motivated differently, subject to even the Maslow hierarchy of needs. So don't say that you have one way to motivate all employees. You must understand your employees to know what motivates each and every employee. Very, very important. Look at, so every employee will motivate by different factor. So don't apply one that this one motivates, but I know money is a universal motivator. Now, then advantage of this contingency approach Why do some people believe in it? Number one is what? Encourages flexible and what? Context-sensitive management. Means you manage
on time value of money. We see how we compute the future value of an investment, how we compute the present value from a future value, and some other illustrations. So let's start with August 2024, question 2B. Let's start with August 2024, question 2B. August 2024, question 2B. So from your past papers, please have that. August 2024, question 2B. That is the question we are starting with. Are you there? Now, are we looking at part B of that question? Now, before we look at part B, look at part A. Part A says, describe 3 types of money market instruments and their related transactions available in the financial system. That is from topic 2 that we covered. And we talked about the money market. Money market, remember we said is the market for short-term funds. Market for short-term funds. So there you find treasury bills, you find commercial papers, promissory notes, and the rest. They are there in the handout that I shared. So let's go to part B. I want, if possible, we do away with this topic today. So I want us to move a bit faster, yeah? So part B, Samuel Mongeka intends to invest shillings 200,000 at the beginning of each year in treasury bonds, which earns a return of 9% per annum. So Samuel Mongeka intends to invest shillings 200,000 at the beginning. At the beginning is very important. At the beginning of each year in treasury bonds, which earns a return of 9% per annum. Required, determine the accumulated value of investment after 10 years. So remember, this person, we're being told that this person will be investing 200,000 at the beginning of each year for a period of 10 years at an interest rate of 9%. So the 200,000 is an annuity. 200,000 shillings is an annuity in this case. So you say annuity. So this is part 1. So annuity is 200,000 because this is happening each year. So it becomes an annuity. Then the interest rate is 9%. 9% per annum. 9% per annum. The required, that is investment after 10 years. The number of periods is 10 years. So he's going to invest for a period of 10 years. This is an annuity due because it is occurring at the beginning. So present value of annuity due, we said is equals to the annuity times. So here we can choose to use we can use the tables or we can use the formula, whichever you want. So 1, let's use the formula for this one. 1 minus 1 plus R. Now we want the future value. We're looking at the future value. So yeah, we are computing the future value, not the present value. So 1 plus R power n minus 1 over R times 1 plus R times 1 plus R. That is the formula that we said for future values. So yeah, so we are going to change here. It's not present value, it's the future value of an annuity, because we are looking at the value of the investment at the end of 10 years or after a period of 10 years. So, and I want to believe we are together. Are we together? So let's proceed. So here we say, the annuity is 200,000 times 1 plus 0.09 power what? Power 10 minus 1 over 0.09 times 1 plus 0.09. So from that, we can get the amount. Get me that figure kindly. You're taking too long, kindly. Yes, you're getting 33, 120, 33, 120, 58.68. So it's what? Sorry. So this is here. It's 3 million. Okay, fine. So that must be the correct answer. That must be the correct answer. So the keynote here, it's the beginning. Remember the question says at the beginning of each period. And that is why we are having this factor here, 1 plus R. So take note of that. Then next part B, not part B, but part 2. Determine the present value of shillings 1.2 million annuity payable for 20 years at an interest rate of 8% per annum. So here, they're saying, determine the present value of shillings 1.2 million annuity payable for 20 years at an interest rate of 8% per annum. So again, this is still an annuity. And this annuity, they're saying, it is 1.2 million that is payable annually for a period of 20 years. So here we will say the annuity is 1.2 million. 1.2 million payable for 20 years. The period is 20 years at an interest rate of 8% per annum. Interest rate is 8% per annum. And we're looking at the present, determine the present value of shillings 1.2 million annuity payable for 20 years at an interest rate of 8% per. So they have not said whether the amount is at the beginning or as at the end of the period. So when the question does not specify when the payment is being done, it is assumed to be an ordinary annuity. So this is an ordinary annuity where the payment is occurring at the end of each period. So present value of annuity, which is an ordinary, we said is equals to the annuity times 1 minus 1 plus r power negative n over r over r over r. So this is 1.2 million times into brackets 1 minus 1 plus 0.08 power negative 20 over 0.08. So get that. Get the present value. Get me the present value kindly. I'm waiting for the answer. Hilda? Eleven 781 720. Eleven 781 776. Point 89. Let's say 89. So that is okay. That is how we get the present value of an annuity. So you can see, these are the same things that we were looking at during our classwork. What you need to do is to get the concept. You need to understand what you are computing, what information has been provided. Have I been provided with an annuity? Have I been provided with a lump sum? And things like that. Let's have another question, a quick one. December 2023. December 2023. December 2023. Question 3C. December 2023, question 3C. For December 2023, question 3C. Are you there? Yeah, question 3C say, no. This is on loan amortization, yeah? This is on loan amortization. December 2023, question 3C and D. Let's do part D. Let's do D, not C, D. We are coming back to part C on loan amortization. So let's have it somewhere. Question 3C. It's on loan amortization. So let's look at part D. Says, 𝐎𝐍𝐋𝐿 has the following investment options to choose from. 𝐎𝐍𝐋𝐿 has the following investment options to choose from. Post office MIS scheme, monthly interest 8% per annum. ICD bank deposit, quarterly interest 8.25% per annum. HDFC Limited have yearly interest 8.5% per annum. Required, using effective interest rate method, advise 𝐎𝐍𝐋𝐿 on the preferred investment option using the effective interest rate. So remember, we said effective interest rate. Effective interest rate, it is adjusting the nominal interest rate with the number of times compounding occurs in a year so as to get an interest rate that is consistent with the number of compounding times. So effective interest rate, we said effective interest rate, we said is equals to 1 plus, this was R over M power M minus 1. That is what we said. That is how we compute the effective interest rate. That is how we compute the effective interest rate, unless I'm getting the formula wrong, but that must be correct. 1 plus R over M power M minus 1 minus 1. So we compute the effective interest rate for each option, and we start with the post office MIS. Post office MIS, where the nominal rate is what we call in RR, 8% per annum. M is 1. Here M is 1. Because if it's the interest rate is per annum, or it's monthly interest rate, monthly, they're saying post office MIS scheme monthly interest. So M is 12. M is 12. M represents the number of times interest is compounded in a year. The number of times interest is compounded in a year is what you're calling M. And in this case, they are compounding monthly. So M is 12. So then the effective interest rate is equals to 1 plus 0.08 over 12 power M 12 minus 1. So get the interest rate here. Get the effective interest rate. Then we will go to ICD bank deposit. Let's first write, then we'll compute. Let's first have this, then we will compute. ICD bank deposit, they're saying quarterly interest. So our nominal rate is 8.25% per annum. M, the number of times compounding occurs in a year. It is quarterly, so 4. Then effective interest rate is equals to 1 plus 0.0825. You divide by 4, then power 4 minus 1 is equals to. And the last one is HDFC Limited. HDFC Limited. Here the nominal rate is 8.5% per annum and half yearly. So here compounding occurs semi-annually, so it must be 2 times in a year. Effective interest rate is equals to 1 plus 0.085 over 2 power 2 minus 1. So now let's compute now. Let's compute. Get me the answer for the first one. Kindly save time, save on time. I've said I want us to do away with this topic today. And we have a lot to cover. %. Okay, whatever answer you are getting, multiply by 100 to get it in percentage. So now the answers are too many here. So for this is 8 point. Oh, that's okay. That's okay. 8.29, 8.3 is okay. Otito, yours is for which one? Because yours is a bit different. ICD. Okay. 8.51. Let's have the answers in 2 decimal places. 8.51. 8.51. Then the other side. HDFC. 8.68. 8.68. 8.68. So I believe that is okay with everyone. A vote that is for 8.5, or that is for this one. Okay, fine. Okay, thank you, vote. That is it for that question. Unless someone has been left behind, we go to another question. Any question before we proceed? Oh yeah, we are supposed to advise. We are supposed to advise because the question says, using effective interest rate method, advise 𝐎𝐍𝐋𝐿 on the preferred investment option. The preferred investment option is the one that provides the highest effective interest rate. So which should be this one, DFC Limited. So say the preferred investment option, advice, the preferred investment option, is HDFC Limited, since it has the highest effective interest rate. Full stop. Then August 2023 question 5B. August 2023 question 5B. And I said, make sure you get the concept. Don't just compute, don't just write. Ensure you understand the question. And one thing, these financial management questions, if you want to get the concept and if you want to survive in financial management, number one, make sure you understand the question. Read the question and understand. Make sure that you can explain the story in that question, so that when you are doing the question, you're just converting whatever you've understood into writing. So like in this question, we're saying August 2023. Question 5B. August 2023 question 5B. That question reads, it's 5B. Joel Ouma needs shillings 5 million in 5 years' time to purchase a house. So this man wants to have 5 million shillings 5 years to come to purchase a house. Then he is determined to deposit a given amount of money each quarter in a sinking fund that earns interest at the rate of 12% compounded quarterly for 5 years. Required, compute the amount of money that Joel Ouma should deposit in each quarter in a sinking fund so as to enable him realize shillings 9 million in 5 years' time. And you can see that question is 5 marks. Very short, but 5 marks. Now, so let's start. Okay, this is now where understanding the question is coming in. You must understand what the question says, what it requires, so that you can know what to do. Now, in this case, you've been given the future value is 9 million. Say future value here. This is the money this person wants after 5 years. So then N is 5 years. Because they're saying Joel Ouma needs shillings 9 million in 5 years' time to purchase a house. He's determined to deposit a given amount of money each quarter. So he's depositing each quarter. So the number of times he's depositing money in a year is 4. Because a year has 4 quarters. So he's depositing 4 times in a year in a sinking fund that earns interest at the rate of 12%. The interest rate is 12%, but compounded quarterly. At an interest rate that's, so they're saying he is determined to deposit a given amount of money for each quarter in a sinking fund that earns interest at a rate of 12% compounded quarterly for 5 years. So now the question is, compute the amount of money that Joel Ouma should deposit in each quarter in a sinking fund so as to enable him realize 9 million in 5 years' time. In 5 years' time. The amount of money that he should be depositing in each quarter in order to make it at 9 million after a period of 5 years. So here we have two methods. We can start by computing the effective interest rate. So, but before that, this is the future value. And we are looking for an annuity. We've just said that future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. That is what we've said. So the annuity, this is what we are looking for. Because the annuity is the amount of money that he will be depositing each quarter. Then the future value of the annuity is the 9 million. So here you can say 9 million. This is the 9 million will come here. This is what we are looking for. How much should he be depositing to make it 9 million after that period of time? We will start with the effective interest rate method. Effective interest rate method. Whereby we are supposed to adjust the interest rates to reflect quarterly. This interest rate here, this 12% we said, we are calling it the nominal interest rate. We said the nominal interest rate is given on annual basis. It is per annum. It is for 1 year, one financial year, or not just annual. It's an annual rate. So, but here, the compounding is done quarterly. That means you're supposed to adjust this interest rate of 12% per annum to reflect quarterly compounding. So here you can just say per annum. So we will start with this. Effective interest rate you're saying is 1 plus R over M power M minus 1. And I said, always in financial management, whenever you're doing a question, write the formulas. Write the formula. Even if you know it, just write the formula. It will even direct you on what to do. Like this one now, it will direct you. You will know this is 9 million. This is what I don't have. The rest I have. So here you'll say effective interest rate is 1 plus 0.12 over 4 power 4 minus 1. So get the effective interest rate. Get the effective interest rate. 12.55. 12.55%. Now this is what we are going to apply as our R. So we'll say future value. Oh, no, we are not repeating that again. We will say present value. Is it present value? No, future value is 9 million is equals to annuity. Annuity is what we don't know, times 1 plus 0.1255 power 5 minus 1 over 0.1255. So first get this factor. Get this factor in 4 decimal places. This factor should be in 4 decimal places. So annuity will be 9 million. You divide by the factor that you're getting here. 6.4226. So please get me the amount here. Divide, you get me this amount. $140. This figure is too big, my friend. This is 1 million, eh? Someone else, kindly. Okay, fine. Let's see, something must be wrong somewhere. This one is for 5 years. Just a minute, we will see, we will compare. We will see where we are going wrong, if at all we are going wrong. We said we have two methods of this, eh? We said we have two methods of doing the multi-period. Remember, we called it multi-period compounding. Multi-period compounding. So just leave this the way it is. We will come back to this. I will check where the issue could be. Now we have this. We said, number one, you can adjust the number of periods. You adjust the number of periods, and again, you adjust the discount rates, and then you do the compounding. So method number two, this is number two. Just say or say number of periods. Number of periods will be 5 times M, 20 years. We will get 20 years there. Then discount rates. Discount rate, we said, sorry. This one should be, so I just wanted to say N times M, which is 5 times 4. You get 20 years. You get 20 years. Then discount rates will be R over 2. Not 2, but M. R over M. So 12% divided by 4. We will get 3%. We will get 3%. So we are saying, instead of using the effective interest rate method, we have another option. We have another option of adjusting the number of periods, because you're saying, if this person is going to save for a period of 5 years, and each year he is saving 4 times. So the number of periods will increase. So it's like saying, we have a period here. This is 0, this is 1, this is 2, this is 3, this is 4, and this is 5. So these are 5 periods. 1, 2, 3, 4, 5. 5 years. But you're saying in each year is making 4 payments. So there are other periods here. 1, 2, 3. 1, 2, 3. 1, 2, 3. 1, 2, 3. 1, 2, 3. So these are not the period, because compounding is occurring quarterly. We are supposed to count this 1, 2, 3, 4, 5, 6, 7. There will be 20. Then the interest rate that we have is for 1 year, 12%. But we are only compounding for quarterly for 3 months. So you divide by 4, you get 3, 3, 3, 3, which must add up to 12. That's why we're saying R over M, we're getting 3%. So with that now, we can apply this formula. we can apply this formula. We say annuity, which is 9 million, annuity, which is 9 million, is equals to annuity times 1 plus 0.03 power 20 minus 1 over 0.03. So then now you say annuity is equals to 9 million over the factor that you'll get there. Let's have in 4 decimal places, Anna, in 4 decimal places. So you get in 33. Three 34, 941. So this is 26. It said 26, 26.87, 26.8704, 8704, 26.8704. Then here the annuity, you're saying shillings, 334,941. 334,941.05. So that should be the correct answer. That should be the correct answer. So that means here, we are supposed to adjust the periods again here. This one, this effective interest rate, we adjust. We adjusted to, like we've adjusted there. So it is the same thing. So here the number of periods will change. So here we are supposed to say divide by, just a minute. You divide this by 4. So this will become 20. Then you divide by 0.1255. You divide by 4. So that is where the issue was. After getting the effective interest rates, you will still again adjust the number of periods. So get that. Just check now. Check now. Okay, it will not be the same, but almost the same. Rounded off. Check whether you're getting the same. Enad, are you getting the same answer? Hi, 330. 330 is a bit low. If you divide 12.55 over 4, then you use 20 here. The same case here. This is becoming almost the same, 3 point something, 27.39. Or 332.82.81. 338.82.81. So I would advise we go with this. This will not complicate issues. This will give us the exact figure, this method. Because here we've adjusted the number of periods, we have adjusted the discount rate, we are getting full numbers, or rather whole numbers. Then we apply the formula, we get this. So this is okay. Let's go with this. Let's go with this. This is more accurate. That is more accurate. That's more accurate. Now, do we need to do another one? Let me see. April 2020, April 2023, question 5D. Let me see whether it's April 2023. If it's similar to what we've done, we're just going to proceed. So they're saying John Osoro has deposited 7 million into a savings account at an annual interest rate of 5% compounded, with additional deposits of 10 per month made at the end of each month. So this is a bit different. I've advised we go with this, Martin. I've advised we go with this method of adjusting the number of periods and adjusting the discount rates. This one will not mislead you. So let's have April 2023 question 5D. April 2023 question 5D. Question 5D. April 2023, question 5B. Now, John Osoro, that question for John Osoro. That question for John Osoro is what you're looking at. The question says, John Osoro has deposited shilling 700,000 into a savings account at an annual interest rate of 5%, compounded monthly. So John Osoro has deposited 700,000 into a savings account at an annual interest rate of 5%, compounded monthly, with additional deposits of shillings 10,000 per month made at the end of each month. Required, determine the value of the investment after 10 years. Determine the value of the investment after 10 years. So here we have a lump sum. We have a lump sum of 700,000, and we have annuities of 10,000 per month. And this will be done for a period of 10 years. So you need to get the present value of each separately. So here we have a lump sum. We have a lump sum of 7 million. They're saying shillings 700,000, sorry. 700,000. So initially he deposits 700,000 shillings into a savings account at an interest rate of 5% per 5% compounded. This is per annum at an annual interest rate, 5% per annum, but compounded monthly. M is 12. M is 12. The number of times compounding is occurring in a year is 12. Then compounded monthly with additional deposits of shillings 10,000 per month. Annuity. There is an annuity here. Shillings 10,000 per month. 10,000 per month. So what I'm saying, how we are going to get the present value of this lump sum is different from how we are going to get the present value of this annuity figure. Because here the question says, determine the value of the investment after 10 years. So here is saying value of investment. Value of investment is equals to present value of the lump sum. No, after 10 years. Determine the value of the investment after 10 years. So value of the investment is equals to future value of the lump sum. Future value of the lump sum plus future value of the annuity. Plus future value of the annuity. Future value of the annuity. Now, we need to adjust this here. Let's start by adjusting the number of periods. Number of periods, we have said, number of periods is equals to n. Where is n here? We don't have n. N is 10 years. N is 10 years. Number of periods is n times m. So n, 10 times what? 12. We get 120. So the number of periods is 120. Then the discount rate or the interest rate, we can just also call it the interest rate. The interest rate is R over M. 5% divided by 12. 5% divided by 12 because compounding is occurring. Compounding is being done monthly. So get the interest rate, that is consistent with compounding period. Five over 12 is what? Five over 12. No, but this one, yeah, let's have it the way it is. 5, if you divide by 12, I'm getting 0.42. Let's say 0.42%. 0.242. Don't forget this is percent, because we are going to divide further by 100. We're going to divide further by 100. So we start with the future value of the lump sum. Future value of lump sum is equals to the lump sum is equals to the lump sum, or let's say future value of a lump sum is equals to present value 1 plus R power N. So this one will be 700,000 is equals to, or rather times 1 plus our R is now the adjusted one, 0.42 over 100 power the periods 120 power 120. That will give us the present value of the lump sum. That will give us the present value of the lump sum. Then future value of the lump annuity. Future value of annuity. Future value of annuity is equals to the annuity times 1 plus R power N minus 1 over R. Again, for R and N, we are going to use their adjusted values. We are going to use the adjusted values. So our annuity is 10,000. 10,000 is what we are saving monthly. So times 1 plus 0.2, 0.42 over 100 power 120 minus 1 over 0.42 over 100. So here we will get the future value of the annuity. So remember, the reason we are just dividing by 100 because we want to convert this percentage to numbers. We are converting the percentage to numbers. So basically, the 100 has no other reason to be there, because you can just say 0.0042 and you'll be good to go. So the first one I'm getting 1157,508. I don't know what you're getting. 1157,508. 1157,508. Confirm whether you're getting the same. 1157,508. Yeah, that's okay. Let's have the present value of the annuity now. So this one is 1 plus 0.0042. Close the brackets, power 120 minus 1 divided by 0.0042 times 10,000 times 10,000, I'm getting 1556 150. 1556 150.42. I believe you're getting the same. 1556 150.42 for the annuity, for the future value of the annuity. Then now you add value of investment is equals to 1157,508 plus 1556,150. Ignore the points. Ignore the points. So this is 2,713,000. Here there is no format. It is just getting the lump sum, and there will be an annuity, and also knowing that how you get the future value of the annuity is different from what you get used. You get the future value of a lump sum. Plus again, adjusting the number of periods with the number of times compounding occurs in a year, and adjusting the discount rate to reflect the number of times compounding occurs in a year. Here, it is just getting the concept, not a matter of cramming or what. So just keep on. We've very many questions on this in the past papers. Even in August 2025, there was a question that's sitting, I don't know. So make sure you look at those questions. And in case you have a question, you will ask. Let's proceed. Let us look at something else because I want us to finish this today. Under that right, loan amortization schedule. Loan amortization schedule. Loan amortization schedule. Loan amortization schedule. Now, a loan amortization schedule, this is a schedule that is used to determine the amount of installment that one should pay when they have borrowed money at an interest rate. The amount of installment one should pay. Now, for example, let's say when you acquire a loan of shillings 1 million at an interest rate of 12% per annum, and the loan period, you're supposed to repay this loan over a period of 4 years. So the question is, you have acquired a loan of shillings 1 million. You're being charged interest at 12% per annum, and the repayment period of the loan is 4 years. So the question is, the installment. How much should this person pay per month? How much should this person pay per month to exhaust the loan amount in a period of 4 years? So in short, you are being asked to compute the installment, the amount payable each either year or each period to exhaust the loan amount plus interest over the period of the loan. And remember, when you borrow a loan, it will be the loan amount, like 1 million plus interest. The amount of money that you pay back, you are not going to pay the 1 million, no. You are going to repay the principal amount of the loan plus an interest that will be charged. So that means you're going to pay more than 1 million. And again, each installment that you make when you're repaying a loan, it has an element of the principal amount and interest. Let's say, for example, after doing all these calculations, you realize that this person should be paying 35,000 shillings per month. Each installment that you're making for loan repayment can be split into two. It has an element of the principal and the interest expense. So you don't say that first I'm going to pay the principal amount, then after paying the principal amount, I will now start paying the interest amount. No. Every time you're making a loan repayment, you are paying an element of the principal and an element of the interest charged. And then you continue until you exhaust the principal amount plus the interest charged on the loan within the period of the loan. So just say one statement and say, write one statement and say, a loan amortization schedule, a loan amortization schedule usually shows the interest charged. A loan amortization schedule usually shows the interest charged for each period. Usually shows the interest charged for each period, comma, installments paid, and the balance outstanding, installments paid and the balance outstanding, at the end of each period, and the balance outstanding at the end of each period, and the balance outstanding at the end of each period. Full stop. And say the annuities stroke installments, can be determined as follows. The annuities stroke installments can be determined as follows. The annuities stroke installments can be determined as follows. So what we are saying is this. An installment, remember, a loan repayment is done using equal installments. These installments must remain the same throughout the loan period. So what you're saying is that installment is equivalent to an annuity. So here we say, to determine the installment, you say present value of annuity is equals to the annuity times present value interest factor annuity R% power n. This is the same as this. So let me write here. We say this expression can be rewritten as this. When you're reading from the tables, you write this. When you're calculating, you write this. So now we are saying this present value is the loan amount. This is the loan amount. Because remember, the loan amount is in present value terms. You're getting the loan today, not tomorrow, today. Then you're going to pay in equal installments, annuities. So these are the installments. The annuity is the installment. So in short, we are saying the present value of the installments gives us the present value of the loan. Present value of the loan is equals to present value, or rather, the loan amount. The loan amount is equals to present value of installments. Present value of installments. So like if we were to do for this question, we would say, for this example, I mean, we would say 1 million. 1 million is equals to installments times present value interest factor annuity 12%. No, here the payment is being done monthly. When the payment is being done, when the installments are monthly installments, you must adjust this. So this will be 12% divided by 12. Then the number of periods here, 4, you say times 12. You get 48 months. So, but let's just have a past paper question for this. Unless you have a question. Any question before we do a past paper question? I want us to look at August 2024. Question 2B. Is it? August 2024. No, sorry. Not August 2024, but April 2024. April 2024, question 4C. April 2024, question 4C. April 2024, question 4C. You're saying April 2024. Question 4C. The question reads, a company negotiates a _30 million loan for 8 years from a financial institution. So a company negotiates a _30 million loan. So loan amount is 30 million. 30 million loan amount. Then, so 30 million shillings, 30 million loan for 8 years from a financial institution. The interest rate is 14% per annum. Interest rate is 14% per annum. Per annum. On the outstanding balance of the loan. So this is what we call the reducing balance method. The principal and interest will be repaid in 8 equal year-end installments. So the repayment period is 8 years. The principal and interest will be repaid in 8 equal year-end installments. Required, prepare a loan repayment schedule. 2, determine the amount of interest payable at the end of the 8th year. So we will start by getting the installments. Like I've said, the most important thing is to get the installments, the amount of the installments. So here, what we are lacking is the installment. This is what we are lacking. We're also very lucky that interest, or rather the repayment, is annually. They're making annual installments. That is what the question says. The principal and interest will be repaid in 8 equal year-end installments. So when we are making yearly installments, we don't need to adjust this. This and this will not be adjusted. So here we'll say present value of annuity. Present value of annuity is equals to the annuity times present value interest factor, annuity, R% power n. So the loan amount is 30 million. 30 million, 30 million is equals to, so this one you said is the installment. So let's have the installment here. Installment times present value interest factor, annuity, present value interest factor of an annuity, 14% for 8 years. For 8 years. So 30 million, okay. So if you divide both sides by what, you'll find that this is, divide this by present value interest factor annuity. No, let's not do that. 30 million is equals to installment times, get this factor from the tables. Get this factor, 14% at period 8. 14% at period 8. 14% at period 8. Go to the WhatsApp group, check the table that I shared the other day. Thank you, Tito. 4.63. 4.6389. And this one we are reading from the lower table. We are reading from the lower table because we are working with an annuity. So please, if you're not getting this figure, we are reading it from the lower table. So divide both sides by this factor. We'll say the installment is 30 million. You divide by 4.6389. 4.6389. So get that. Divide, get the installment. Oh, 64. 60. Priska, what is 73.82? 64, 67. 64, 67, 050. 64, 67, 050. 0.38. Priska, 73.82 is what? Okay, let's now prepare the loan repayment schedule. Loan repayment schedule. Loan repayment schedule. So here we start with period. The period. We have 8 periods. 1, 2, 3, 4, 5, 6, 7, 8. We have 8 periods. Thank you, Priska. 8 periods. So now here we will have balance brought down or balance brought forward, whichever. Balance brought forward. Then here you'll have interest. We are charging interest at 14%. We are charging interest at 14%. Then here we have installments. And here we have balance carried forward. Balance carried forward. So this is A, this is B, this is C. So this is A plus B minus C. A plus B minus C. A plus B minus C. Then this is the repayment fee, loan repayment schedule. Loan repayment schedule. Now, we are saying interest is being charged on reducing balance. Interest is charged on the amount due. So after you repay, the next time you're calculating interest, you calculate on a lesser balance. So we will have this. So we start with the 30 million. 30 million is the balance brought forward in period 1. 30 million is the amount brought forward in period 1. Charge interest. We charge interest on the 30 million. We charge interest. So 14%, 14% times 30 million, 1, 2, 3, 1, 2, 3. 4.2. 4.2 million. 4.2 million. Then we have an installment. We make a payment of 64, 67, 050. Let's do away the points. Let's do away the points. Remember, the installments must remain the same. So you can drop the installments 64, 67, 050, 64, 67, 050, 64, 67, 050, 64, 67, 050, 64, 67, 050, and 64, 67, 050. After paying the last installment, we should have a 0 there. We should have a 0. Remember, we have said installments must remain the same. They are constant amounts. So let's continue. Now we want to get the balance carried forward here. So the balance carried forward here, we are saying, is the balance brought forward plus interest minus the installment. Minus the installment. So you say 30 million minus 4.2 million. Plus you add interest. Interest increases the amount due. Which is which here? Minus 6467. So you're saying 30 million plus 4.2 minus 6467 050. 27, yes, 27 732 950. Then this one you bring it forward here. 27 732 950. Bring it forward here. Then you charge interest on this figure here. Charge interest on the balance brought forward. Again, 14%. So this is 38 82 613. 38 82 613. Add 27 732 950, and you deduct the installment 64 67 050. Here I'm getting 27 148, no, 25 148 513. 25 148 513. That is what we're going to bring forward here. 25 148 513. Then again you charge interest. It's 3520 791.82. 791.82. So then plus 25 148 513 minus the installment 64 67 050. So here I'm getting 22 202 254.82. That is what we bring forward here. So here brought forward it's 22 202 254.82. Charge interest at 14%. This interest is 3,108 315.67. Then we get the installment, not the installment, but the balance there. So this is plus 22,202, 254.82 minus 6467 050. So here I'm getting 843 520.49. So here 843 520.49. Then times 1.4. Then 2638 092 0.87. So 18,843, 520.49 minus the installments, 6467, 050. So here I'm getting 15,014, 563.35. And that is the balance brought forward. Here, 15,014, 563.35. Charge interest at 14% on that figure. I'm getting 21,02, 038.87. Then we add to the balance brought forward 15,014, 563.35 minus 6467, 050. 10,649, thank you. 10,649, 552.22. Yeah, so 10,649, 10,649, 552.22. So charge interest, it's 1490, 1499.37.31. So plus 10,649, 552.22 minus 6467, 050. 5673, 439, yes. 5673, 439.53. So that is the balance brought forward here. 5673, 439, 5673, 439.53. Then we charge interest at 14%. It's 794, 281.53. 6467, 050. So after payment of the last installment, you are supposed to exhaust everything. So just check whether we are exhausting 5673, 439.53 minus 6467, 050. Yeah, you'll get like a balance of 671, eh? You'll get like a balance of 671. 671, it is because of rounding off. It is because of rounding off, eh? There is no loan that you can pay until you get 0. It's not possible. It's not possible unless maybe you're charging interest on straight line basis. So that is how the loan amortization schedule is done, unless you have a question. Any question? So the most important thing is to know how to compute the installment. And please note, if the repayments are done monthly, you will have to adjust the repayment period, which is 8 years you multiply by. For example, if we were told that the installments are monthly, here you would say 8 times 12. 8 times 12 is what? Is it 48? Not 48. It's 96. 96 months. Then the interest rate, you would say 14%, you divide by 12. You'll get a figure here. If payments were done monthly, then with this calculation, the amount of the installment here would change. So you should be aware of all that. Then the number of periods here would not be years. They would be months. Now let's answer the last part. And the last part says, determine the amount of interest payable at the end of the 8th year. The amount of interest payable at the end of the 8th year is this. Interest at the end of 8th year. Interest at end of 8th year is this. 794, 281.53. 794, 281.53. Alan, what is 1.67? Okay, fine. I get your point. Yeah. So here it would be 1.167. 1.167. Yeah. So any question? A similar question is December 2023, question 3C. Let me see. Yeah, December 2023, question 3C. I want you to go and do that question. And please make sure you do. Make sure you attempt that question. It will test whether you've understood. DEC 2023, question 3C. So that next time we can start something else. December 2023, question 3C. Oh, a very good question you've asked, Erastus. They have said what? Which question was that? The question was the same, was what? The question was April 2024. They are saying, determine the amount of interest payable at the end of the 8th. Determine the amount of interest payable at the end of the 8th year. At the end of the 8th year. Determine the amount of interest payable at the end of the. So what do you think? The amount of interest payable at the end of the 8th year. Alan, you're saying, okay, Alan, we are coming to that. Let's first answer this. Determine the amount of interest payable at the end of the 8th year. The amount payable at the amount of interest payable at the end of the 8th year should be this. So, but if they had said the amount of interest payable at the end of the 8-year period, 8-year period, we would have added everything. The amount of interest payable at the end of the 8-year period would be the summation. But here they are very specific. Payable at the end of the 8th year. Payable at the end of the 8th year. The interest payable at the end of the 8th year is 794,281. But the interest payable over the 8-year period is this one, the summation. So Erastus, I believe that is clear for you. Alan, you're saying if, for example, it's 12 months, Number of periods we use 12, or instead yearly. Okay, if it's 12 months, number of periods you don't use 12. It will be 96 periods. It will be 96. It is 8 years. The loan amount is 8 years times 12. You will get 96. So you're supposed to write here 1 all the way to 96. All the way to 96, because they will be monthly periods. They will be monthly periods. Yeah. Any other question before we close? So after attempting this question, if you are okay, next time we will start a new topic. That is on Wednesday, we will start a new topic, because that is all about time value of money. With that, have a good night. See you on Wednesday. Today we are going to have illustrations on time value of money. We see how we compute the future value of an investment, how we compute the present value from a future value, and some other illustrations. So let's start with August 2024, question 2B. Let's start with August 2024, question 2B. August 2024, question 2B. So from your past papers, please have that. August 2024, question 2B. That is the question we are starting with. Are you there? Now, are we looking at part B of that question? Now, before we look at part B, look at part A. Part A says, describe 3 types of money market instruments and their related transactions available in the financial system. That is from topic 2 that we covered, and we talked about the money market. Money market, remember we said, is the market for short-term funds. Market for short-term funds. So there you find treasury bills, you find commercial papers, promissory notes, and the rest. They are there in the handout that I shared. So let's go to part B. I want, if possible, we do away with this topic today. So I want us to move a bit faster, yeah? So part B, Samuel Mongeka intends to invest shillings 200,000 at the beginning of each year in treasury bonds, which earns a return of 9% per annum. So Samuel Mongeka intends to invest shillings 200,000 at the beginning. At the beginning is very important. At the beginning of each year in treasury bonds, which earns a return of 9% per annum. Required, determine the accumulated value of investment after 10 years. So remember, this person, we're being told that this person will be investing 200,000 at the beginning of each year for a period of 10 years at an interest rate of 9%. So the 200,000 is an annuity. 200,000 shillings is an annuity in this case. So you say annuity. So this is part 1. So annuity is 200,000 because this is happening each year. So it becomes an annuity. Then the interest rate is 9%. 9% per annum. 9% per annum. The required, that is investment after 10 years. The number of periods is 10 years. So he's going to invest for a period of 10 years. This is an annuity due because it is occurring at the beginning. So present value of annuity due, we said is equals to the annuity times. So here we can choose to use we can use the tables or we can use the formula, whichever you want. So 1, let's use the formula for this one. 1 minus 1 plus R. Now we want the future value. We're looking at the future value. So yeah, we are computing the future value, not the present value. So 1 plus R power n minus 1 over R times 1 plus R times 1 plus R. That is the formula that we said for future values. So yeah, so we are going to change here. It's not present value, it's the future value of an annuity, because we are looking at the value of the investment at the end of 10 years or after a period of 10 years. So, and I want to believe we are together. Are we together? So let's proceed. So here we say, the annuity is 200,000 times 1 plus 0.09 power what? Power 10 minus 1 over 0.09 times 1 plus 0.09. So from that, we can get the amount. Get me that figure kindly. You're taking too long, kindly. Yes, you're getting 33, 120, 33, 120, 58.68. So it's what? Sorry. So this is here. It's 3 million. Okay, fine. So that must be the correct answer. That must be the correct answer. So the key note here, it's the beginning. Remember the question says at the beginning of each period. And that is why we are having this factor here, 1 plus R. So take note of that. Then next part B, not part B, but part 2. Determine the present value of shillings 1.2 million annuity payable for 20 years at an interest rate of 8% per annum. So here, they're saying, determine the present value of shillings 1.2 million annuity payable for 20 years at an interest rate of 8% per annum. So again, this is still an annuity. And this annuity, they're saying, it is 1.2 million that is payable annually for a period of 20 years. So here we will say The annuity is 1.2 million. 1.2 million. Payable for 20 years. The period is 20 years. At an interest rate of 8% per annum. Interest rate is 8% per annum. And we're looking at the present, determine the present value of shillings 1.2 million annuity payable for 20 years at an interest rate of 8% per. So they have not said whether the amount is at the beginning or as at the end of the period. So when the question does not specify when the payment is being done, it is assumed to be an ordinary annuity. So this is an ordinary annuity where the payment is occurring at the end of each period. So present value of annuity, which is an ordinary, we said is equals to the annuity times 1 minus 1 plus r power negative n over r over r over r. So this is 1.2 million times into brackets 1 minus 1 plus 0.08 power negative 20 over 0.08. So get that. Get the present value. Get me the present value kindly. I'm waiting for the answer. Hilda? Eleven 781 720. Eleven 781 776. Point 8.9. Let's say 8.9. So that is okay. That is how we get the present value of an annuity. So you can see, these are the same things that we were looking at during our classwork. What you need to do is to get the concept. You need to understand what you are computing, what information has been provided. Have I been provided with an annuity? Have I been provided with a lump sum? And things like that. Let's have another question, a quick one. December 2023. December 2023. December 2023. Question 3C. December 2023, question 3C. So December 2023, question 3C. Are you there? Yeah, question 3C say, no. This is on loan amortization, yeah? This is on loan amortization. December 2023, question 3C and D. Let's do part D. Let's do D, not C, D. We are coming back to part C on loan amortization. So let's have it somewhere. Question 3C. It's on loan amortization. So let's look at part D. Says, 𝐎𝐍𝐋𝐿 has the following investment options to choose from. 𝐎𝐍𝐋𝐿 has the following investment options to choose from. Post office MIS scheme, monthly interest 8% per annum. ICD bank deposit, quarterly interest 8.25% per annum. HDFC Limited have yearly interest 8.5% per annum. Required using effective interest rate method. Advise 𝐎𝐍𝐋𝐿 on the preferred investment option using the effective interest rate. So remember, we said effective interest rate. Effective interest rate, it is adjusting the nominal interest rate with the number of times compounding occurs in a year so as to get an interest rate that is consistent with the number of compounding times. So effective interest rate, we said effective interest rate, we said is equals to 1 plus, this was R over M power M minus 1. That is what we said. That is how we compute the effective interest rate. That is how we compute the effective interest rate, unless I'm getting the formula wrong, but that must be correct. 1 plus R over M power M minus 1 minus 1. So we compute the effective interest rate for each option, and we start with the post office MIS. Post office MIS, where the nominal rate is what we call in RR, 8% per annum. M is 1. Here M is 1. Because if it's the interest rate is per annum, or it's monthly interest rate. Monthly. They're saying post office MIS scheme monthly interest. So M is 12. M is 12. M represents the number of times interest is compounded in a year. The number of times interest is compounded in a year is what you're calling M. And in this case, they are compounding monthly. So M is 12. So then the effective interest rate is equals to 1 plus 0.08 over 12 power M 12 minus 1. So get the interest rate here. Get the effective interest rate. Then we will go to ICD bank deposit. Let's first write, then we will compute. Let's first have this, then we will compute. ICD bank deposit, they're saying quarterly interest. So our nominal rate is 8.25% per annum. M, the number of times compounding occurs in a year, it is quarterly, so 4. Then effective interest rate is equals to 1 plus 0.0825, you divide by 4, then power 4 minus 1 is equals to. And the last one is HDFC Limited. HDFC Limited. Here the nominal rate is 8.5% per annum and half yearly. So here compounding occurs semi-annually, so it must be 2 times in a year. Effective interest rate is equals to 1 plus 0.085 over 2 power 2 minus 1. So now let's compute now. Let's compute. Get me the answer for the first one. Kindly save time, save on time. I've said I want us to do away with this topic today. And we have a lot to cover. %. Okay, whatever answer you are getting, multiply by 100 to get it in percentage. So now the answers are too many here. So for this is 8 point. Oh, that's okay. That's okay. 8.29, 8.3 is okay. Otito, yours is for which one? Because yours is a bit different. ICD. Okay. 8.51. Let's have the answers in 2 decimal places. 8.51. 8.51. Then the other side, HDFC, 8.68. 8.68. 8.68. So I believe that is okay with everyone. A vote that is for 8.5, or that is for this one. Okay, fine. Okay, thank you, board. That is it for that question. Unless someone has been left behind, we go to another question. Any question before we proceed? Oh yeah, we are supposed to advise. We are supposed to advise because the question says, using effective interest rate method, advise 𝐎𝐍𝐿 on the preferred investment option. The preferred investment option is the one that provides the highest effective interest rate. So which should be this one, HDFC Limited. So say the preferred investment option, advising the preferred investment option, is HDFC Limited, since it has the highest effective interest rate. Full stop. Then August 2023 question 5B. August 2023 question 5B. And I said, make sure you get the concept. Don't just compute, don't just write. Ensure you understand the question. And one thing, these financial management questions, if you want to get the concept and if you want to survive in financial management, number one, make sure you understand the question. Read the question and understand. Make sure that you can explain the story in that question, so that when you are doing the question, you're just converting whatever you've understood into writing. So like in this question, we're saying August 2023. Question 5B. August 2023 question 5B. That question reads, it's 5B. Joel Ouma needs shillings 5 million in 5 years' time to purchase a house. So this man wants to have 5 million shillings 5 years to come to purchase a house. Then he is determined to deposit a given amount of money each quarter in a sinking fund that earns interest at the rate of 12% compounded quarterly for 5 years. Required, compute the amount of money that Joel Ouma should deposit in each quarter in a sinking fund so as to enable him realize shillings 9 million in 5 years' time. And you can see that question is 5 marks. Very short, but 5 marks. Now, so let's start. Okay, this is now where understanding the question is coming in. You must understand what the question says, what it requires, so that you can know what to do. Now, in this case, you've been given the future value is 9 million. Say future value here.
Number one, you're told, yes, I think we are recording our session. So number one, you're told the assets are to be adjusted to their fair value as follows. So the asset now will be revalued to those particular values. So trade receivables 36, inventory 64, machine 2,000, buildings 5,000, and then we are given the accumulated depreciation to be charged. So that accumulated depreciation, basically, which you're given there, basically we need to ignore that, because generally what we know is that you cannot revalue an asset and you depreciate it at the same time. You revalue an asset and then you depreciate it at the end of what? At the end of there. So that was just to confuse you. So we will just work with those particular what? Fair values. So what we need to do is we compare those particular values given in note 1 with the values we have in the statement of financial position of the carrying amount. We determine whether you have a revaluation or actually an increase or a decrease in the value of the asset. We start with the receivables. Receivables in the statement of financial position, its value is 72, but receivables will be revalued to 36. So meaning that for receivables, the value for receivables is reduced from 72 to 36. So we have a decrease of 36. From 72 to 36, that is a decrease of 36. The other asset is basically inventory, which is still part of the current asset. Its carrying amount is 4,000, but it will be revalued. It will be revalued. It will be revalued to an amount of how much? It will be revalued to an amount of what? To an amount of 64. Okay, sorry. I think we are like interchanging. So the value for receivables is 4,000. It will be revalued to 36. So mean that we have a decrease of 400. A decrease of 400. So then we have inventory. Inventory will be revalued to 64. The carrying amount for inventory in the balance sheet is 72. So we have a decrease of what? A decrease of 800. A decrease of 800. A decrease of 800 from 72 to 64. Yes. So then from there we have machine. Machine, its carrying amount is how much? The carrying amount for machine is 28. It will be revalued to 2,000. So we have a decrease of 800. We have a decrease of 800. And then buildings, it will be revalued to 5,000. From 6,000, we equally have a decrease of what? Of 1,000. A decrease of what? Of 1,000. Sasa, yes, in that case, I've said both depreciations which are given there, we ignore them. I've said you cannot revalue an asset today and you depreciate the asset at the same time. So you revalue, then depreciate the asset at the end of the year. So therefore, we ignore those depreciations. So basically, it means that the value for all those assets, receivables, inventory, machine, building, the value reduces. How do we account for that decrease in the value of the asset? We said once the assets have been revalued and their value reduces, we need to credit the specific asset account in order to reduce its value. We complete the double entry by debiting the account called the capital reduction account. So therefore, the first general entry here is basically to account for the revaluation of those assets. To account for the revaluation of those assets. So if you check those values, they are basically in thousands of shillings. Okay, so when making the general entry, let's have the debit column here. And basically the credit column. So we always start with the account to be debited. That's basically what we know. The account to be debited is the capital reduction account. And this account will be debited with the total decrease, or actually with the decrease, the total decrease in value for all the assets. We have 400, 800, 800, and 1,000. That will give us a total decrease of how much? That should be 12, 2,000, 3,000. Are you getting a total decrease in the value of assets to be 3,000? To be 3,000. We try to hurry because of time, yes. So then we debit that account, capital reduction account, and then we credit a number of assets. Which account are we crediting? First of all, we credit the receivables account. The receivables account is an amount of 400. We also credit the inventory account. The inventories account is an amount of 800. We credit the machinery account with an amount of 800. We also credit the buildings account. The buildings account is an amount of what? With an amount of 1,000. With an amount of what? Of 1,000. And then in this case, we said, make sure you give a brief narration. The narration will be being a revaluation of assets. Being a revaluation of who? Of assets. Being a revaluation of assets. So we have accounted for the revaluation of assets. Let's move to note number 2. In note number 2, we are told its ordinary share is to be redesignated as a share of 2.5. And then you're told the ordinary shareholders are to accept a reduction in the nominal value of their shares from 10 shillings to 2.5. In addition, the shareholders are to subscribe for a new issue on the basis of 1 share for every 2 shares held at a price of 4. Now, 2 things there. Number one, we need to account for the decrease in the value of the asset, because we are told the shareholders will accept a decrease in the value of the share from 10 shillings all the way to 2.5. In this case, what we need to account for here is the amount of share capital, which automatically was written off. So the amount of share capital written off, first of all, we determine the amount which was written off per share. If the company is reducing the par value of the share from 10 to 2.5, it basically means that part of the par value has been written off. The amount written off is that decrease. So the value of the share is reducing with how much? Is reducing from 10 to 2.5. The value of the share, therefore, is reducing with 7.5. We multiply that with the shares issued by this company. And in this case, I hope you can see that information deals, note number 2 deals with the ordinary shares. So we go back to the balance sheet of this company, specifically at the equity. That's where we get the shares issued. So how many shares were issued by this company? We take the equity share capital or the ordinary share capital, which is 20,000. Remember, these are not shares. This is the share capital. How do we get the number of shares? We divide that with the par value, which is still in the balance sheet at the equity. I hope you can see the word equity shares of shillings 10 par value. So therefore, the shares issued by this company are 2,000. We multiply that with 7.5. And that basically will give us what? That will give us what? Will that give us 15,000? 15,000, the amount of share capital which is written off. The amount of share capital which is written off. Yes. So how do we account for that? How do we account for this? Remember, we say, in case we want to reduce the share capital, remember share capital has a credit balance. So if we want to reduce this, we debit that account. We debit share capital. We complete the double entry using the capital reduction account. So therefore, in this case, we will debit the equity share capital account. Equity share capital account with the amount which was written off, 15,000. And then we complete the double entry by crediting the capital reduction account with the same amount of 15,000. The same amount of 15,000. What is our narration here? Our narration is being the share capital, which is written off. So what we have accounted for here is the share capital which is written off, being the share capital written off, being the share capital written off. So in the same point, number two, we are told, other than the company writing off the value of each share, we are told the existing shareholders of the company will subscribe. To subscribe is to buy. If you buy shares of the company, you pay for those shares. So in this case, we are told they have to subscribe. They have to buy a new or basically new shares on the basis of 1 share. So these are the new shares to be issued. New shares to be issued. And basically I've said that these are shares to be issued in cash. The existing shareholders will buy some shares. So they are to subscribe new shares on the basis of 1 share, on the basis of 1 share for every what? For every 2 shares which are held, for every 2 shares which are held. Now, how many ordinary shares are currently held? From what you have done up here, how many shares are currently held by the existing shareholders? The shares currently held, yes, we have said are 2,000. So these are the shares which are currently held. So we just cross multiply, then we divide, so that we determine how many shares are currently held. Sorry, how many shares will be issued, not held. So the shares to be issued will be 1 times 2,000 divided by 2, and basically this will give us 1,000 shares. 1,000 shares, and then we are told each share will be issued at 4 bob. Each share will be issued at an amount of 4 shillings. So meaning that the amount of money the company received here would be 4,000. So how do we account for this particular amount received by the company? How do we account for that amount received? Number one, because this money was received, the shareholders paid for that money, we debit the bank account. Remember this money received, we debit bank, and then the company issued shares. So we credit the equity share capital account. Remember, the amount credited to be credited in this account always has to be based on the par value. Now, what is the new par value per share? What is the new par value per share here? What is the new par value per share? The new par value per share, Ningapi. The new par value per share is 2.5. Remember, it was previously 10. It has been reduced to 2.5. So therefore, the amount to be credited in this account will be based on the par value 2.5 times the shares issued. The shares issued were 1,000. So the amount credited in this account is 225, 2.5. Now, it automatically means that because the shares were issued at COBOB, the shares were issued at a premium, at a share premium. We said whenever we are accounting for external reconstruction and shares have been issued at a share premium, that share premium is not taken to the share premium account, but rather we credit it in the capital reduction account. Sasa, yes, that amount we will not credit it in the share premium account, but basically we credit it in which account? The capital reduction account. And automatically that should be the difference here. That should be the difference 15. So we give a brief narration being issue of additional shares, or maybe being issue of shares for cash. So we are done with that. Let's move to point number 3. We are told the existing preference shareholders are to be exchanged for a new issue of 6 million, 15% preference shares of shillings 10 each, and 800,000 ordinary shares of shillings 2.5. So it basically means that if we go back to the balance sheet of this company, specifically at the equity, you'll see this company had issued 12%, not 12%, rather 10% preference shares. So the preference shares issued by this company, they have a value of 8,000. So we are told the holders of these particular shares will be required to surrender them back to the company, in exchange of what? In exchange of what? In exchange of 6 million. In exchange of 6 million, 6 million preference shares, having a value of 10, and 800,000 ordinary shares, 800 ordinary shares, each share having a value of 2.5. Yes, and I think usually this question, there is a small typo, a small typing error. So this particular amount here, you see this amount here, 6 million, that's 6 million, that should be shillings. Because you can see that these preference shares currently issued by the company, they have a value of 8 million. So automatically, once they are required to surrender them back to the company, they are required to surrender these shares back to the company, they must be issued with other shares or even debentures having the same value. Having the same value. So if you take 6 million times 10, because you can see, take into account we don't have the word shillings before 6 million. We can only take 6 million to be the shares. So you should take the share 6 million times 10. That will give us 60 million. You can see that one is more than that. So that's why I'm saying there was a small typing error. This one should be shillings. If you have the physical paper, so before the word 6 million, we should have 6 million. The issue of 6 million, 15% preference shares of shillings 10, and 800,000 2.5, or ordinary shares of 2.5, such that if you work out this now, you work out this 6 million, and then these ordinary shares which were issued 800 times 2.5. So if you multiply these two, this will give us what? Is it 2,000? 800,000 times 2.5. Is it 2,000? Yes, it should be 2,000. Such that if you add this and that, that should give us 8,000. So these preference shares which were issued and these ordinary shares which were issued, they must be having the same value, because the old shares, the old preference shares which have been issued are to be exchanged with the new shares. Yes, so that's why I've said there was a small typing error as far as that question is concerned. Now, what we need to do here is, number one, we cancel these shares. We cancel these shares. How do we cancel them? We cancel them. Remember, this account has a credit balance. So to cancel this, we will debit this account, and then we go ahead and basically debit to account. We debit this account for the new preference shares which were issued, and also we credit. That is to credit that account, and also we credit ordinary share capital. So we debit the 10% preference share capital, and then we credit to account. So we are canceling the old shares and accounting for the new shares which were issued. So we debit the 10% preference share capital account with an amount of 8 million, or basically 8,000, and then we credit these preference shares which were issued. They were 15%. We credit 15% preference shares, preference share capital account with 6 million, and then we credit equity share capital with an amount of 2,000. With an amount of 2,000. Yes. So what is the narration? Being the odd preference shares which were cancelled. Being the odd preference shares which were cancelled. Yes, and I think we are done with that particular point. Let's move to point number 4. Let's move to point number 4. In point number 4, what are we told? We are told that the debenture holders are to accept 200,000 ordinary shares of shillings 2.5 each in lieu of interest payable. Then you're told the 12% debentures are to be converted to 14% debentures. And then you're told a further shillings 2 million or 14% debentures of shillings 10 each are to be issued and taken up by the existing debenture holders at 90 shillings per debenture. So in that case, I think we have like 3 transactions we need to account for. Number 1, let's account for what we have in the first sentence. We are told the debenture holders are to accept 200,000 ordinary shares of shillings 2.5 in lieu of the interest payable. It basically means that the interest which was supposed to be paid to the debenture holders was in arrears. So instead of the debenture holders being paid, that interest which was in arrears, they will accept. They will, instead of being paid that interest in cash, they will be issued with the ordinary share of the company as a form of a payment. So first of all, we need to determine how much was this interest, or how much was the interest in arrears. That one is in the balance sheet of the company below paragraph 1 and specifically under equity. Can you be able to see the interest payable on debentures, or the interest payable to the debenture holders under equity? Under equity, yeah, that one should be 720, not 2,000. Should be 720. So basically, what we need to do, remember that is a liability. So being a liability, we are told this amount automatically will be paid. How will it be paid? It will be paid by the company issuing shares. So we need to first of all cross off this account. Because the liability has a credit balance, how do we cross that account? We debit that account. So the journal entry number 5 is to debit that account. We debit the account called interest payable on debentures with an amount of how much? 720. And then the debenture holders here will be paid by being issued with the shares. So how many shares will be issued to the debenture holders? The debenture holders, in that case, we are told as per note number 4, they will be issued with 200,000 ordinary shares over 2.5. Of 2.5. Automatically, if you multiply these two, that one will give us 500,000. 500,000. So what happens, or what is the difference now here? You can see the amount which was to be paid 720, but the shares issued, they had a par value of 500. What happens to the difference? And remember, the amount to be debited has to be equal to the amount to be credited. Yes, the difference is the share premium. Do we take it to the share premium account? No. So we have said any share premium, any shares which are issued at a premium, any share premium is taken to the capital reduction account. So the difference here, which is 220, is the share premium. But do we credit it in the share premium account? No. We credit it in the account called the capital reduction account. Capital reduction account. So we can say in the narration, being payment of accrued interest. Being payment of accrued interest. So still in the same point, we are basically done with that. Still in the same point, sentence 2, we are told that the 12% debentures are to be converted to 14% debentures, just like what we have done here. So what we need to do is we need to cross off the 12% debentures account. If we go back to the balance sheet of the company here, under equity, you'll be able to see that our company had issued 12% debentures. 12% debentures. We are given their value. We know debentures is a liability. So this account should have a credit balance. So these debentures are to be exchanged, to be converted, that is, to 14% debentures. What does that mean? It basically means that we need to cross off that account by debiting it, and then we open another account called 14% debentures. So this account, we credit it with the same amount. So we debit the 12% debentures basically to cross off that account, and then we credit the 14% debentures account. So what is the value of these 12% debentures from the balance sheet of our company? The 12% debentures, they had a value of 6,000. So in other terms, we have converted the 12% debentures into 14% debentures. So narration, being conversion of 12% debentures into 14% debentures. Being conversion of debentures, or you can just put it like that. Remember that narration has no mark, but it's always good to give a narration of what you have accounted for. Sasa, yes. In the same point, we also have other debentures which were issued in cash. In the last sentence, a further shillings 2 million 14% debentures of shillings 100 are to be issued and taken up by the existing debenture holders at 90 bob. So these are new debentures to be issued. The 14% debentures, we are told having a value of 2 million, having a value of 2 million, but in this case, we are told their par value is 100, but basically they will be issued at a discount. They'll be issued at a discount because we are told they will be issued at 90 bob. So basically what that means is that our company here, instead of receiving 2 million, the cash to be received, the cash received will be what? Will be 90 all over 100 times what? Times 2 million. In other terms, because they have a value of 100, but they will be issued at 90, it's like they were issued at a discount of 10%. Sasa? Yes. So the amount to be received should be equal to what? Should be equal to 90%. Because they were issued at a discount of 10, the company received 90% of 2 million, which is 1.8. 1.8. So that is basically the amount to be received. How do we account for this amount received? The amount received, number one, this one will be debited in the bank account. We debit the bank 18 with the cash which was received. With the cash which was received. Now, the difference which is, or actually the discount, which is 200,000, which is the discount, that one, basically we take it to which account? We take it to the capital reduction account. We must account for that discount. So that discount is 200,000. We take it to the capital reduction account because by the end of the day, the amount to be credited in this account, the amount to be credited in the 14% debentures, 14% debentures, just like what you have said in relation to the shares, that one has to be based on the par value. Remember, the par value is 100. So the amount to be credited in this account has to be based on the par value of 100. So meaning that the amount to be credited in this account should be 2,000. It has to be based on the par value, just like the shares, So the narration being an issue of debentures for what? For cash. Being issue of debentures for cash. We are basically done with that. So let's move to the other point, number 5. In note number 5, we are told shillings 800,000 of the loan from directors is cancelled. And then you're told the balance of the loan is to be settled by the issue of 200,000 shares of shillings 2.5. So first of all, can we go back to the balance sheet of this company? We check how much was the loan from the directors. The loan from directors, that has to be either below, as a liability, basically. The loan from the directors is a liability. Yes, and I can see that that one is given together with the share capital. So the loan from directors is basically 2,000. So what we are told in note number, let's go back to note number 5. We are told 800,000 of this. Shillings 800,000 will be cancelled. In other terms, it will be written off. Whereas the balance is to be settled by issue of shares. So the balance will be settled by issue of shares. So how do we account for that basically? Remember, this account loan from directors is a liability account. So being a liability account, the account has a credit balance. So part of this amount is to be written off. We debit it here. The amount written off, we debit it in that account. Then the balance, which is basically 1,200, this one will be settled by the company by issuing shares. By issuing what? Shares. So therefore, we make a journal entry for that. So we debit this account, loan from directors. First of all, let's account for this amount which was written off. Loan from directors. Loan from who? Directors. We debit that account with 800,000. So automatically the other entry will be in which account? Will be in the capital reduction. No, let's do this. This account basically we debited with the total amount, because the full amount will be written off. Will be written off. But now when accounting for this amount which was written off, remember this amount will be debited in this account and then credited in which account? And that amount which was written off will be credited in the account called the capital reduction. This is the amount which was written off, the loan which was written off. It will basically be debited here, credited in which account? Capital reduction. Then this amount which was paid through the issue of shares, I hope you can see the number of shares which were to be issued to the directors. The directors were to be issued with how many shares? Are we given the number of shares which were to be issued to the directors? Yes, the directors were to be issued with 200,000 shares. 200,000 shares, each share having a value of 2.5. So if you multiply these 200 times that basically will give us 500. But you can see the amount which was to be paid by the company through the issue of shares, Ningapi, the amount which was to be paid through the issue of shares was 1,200. It also means that these particular shares which were issued to the directors were issued at a premium. Is that the position? Are they issued at a premium? Yes, because you can see the amount which was to be paid was 12, but the par value of those shares is 500. So therefore, what will be the double entry for that? We will credit the equity share capital with the shares which were issued, which are 200 times 2.5. 2.5, basically that will give us 500. So the difference between 500 and 12 will be a share premium. Where do we take the share premium? To the capital reduction account. To the capital reduction account. Remember, that is the share premium. That is the sharehood, the share premium on the shares which were issued. So by the end of the day, if you add this, the amount to be credited, the amount to be what? The amount which has been debited, you'll be able to see the amount is the same. So 800 plus the 500, which is 13, plus 700, 2,000, which is equal to that. So this is our narration being director's loan, which was cancelled, director's loan cancelled and paid. So we have accounted for the director's loan which was cancelled and the one which was paid. We are basically done with that. So then let's move to the other point, number 6, and I hope you're together up to that point. I hope you're together up to that point. Are we together up to that point? Can we move to point number 6? Yes, we are together up to that point. So in point number 6, you're told the investment are to be sold at their current market value of 6 million. So which are these particular investment? Investment automatically should be an asset. So if we go back to the balance sheet of this company, below the non-current assets, I can see we have intangible assets. One of the intangible assets is investment. The value for investment is 45. So we are told that investment, as per note number 6, we are told that investment will be sold at the current market value of 6 million. So the investment will be sold at a profit, because if you take the carrying amount of that investment is 45, but the investment will be sold at 6,000. So that profit, that gain on the sale of investment, that one automatically we cross it off, we take it to the capital reduction account. So first of all, we account for the amount which was received. The amount received, that one is debited in the bank. So how much amount was received? It should be equal to the sales proceeds. Sales proceeds is what we have in note number 6. Our investment was sold at 6 million. That is what we debit in the bank. That is what we debit in the bank. And then the amount which we credit in the investment account should be equal to the carrying amount. Investment was recorded at 4.5. We credit that account with 4.5. The difference, which is basically 15, we are saying is the gain on the sale of investment. So that gain on sale of investment, where do we take it? We take it to the capital reduction account. To the capital reduction account. So the narration here is being what? Being investment sold. Being investment which was sold, being investment which was sold. Being investment which was sold. We are basically done with that. Let's move to point number 7. You're told bank overdraft was paid in full. Also very simple. Bank overdraft, we know, is a liability. Is a liability. So if bank overdraft was paid and is a liability, we need to cross off this account by debiting that. We debit that account, we credit bank account. So we debit bank overdraft account. Bank overdraft, this one has to be part of the current liabilities in our balance sheet. And the bank overdraft is basically 3,000. And then we credit bank account with an amount of 3,000. So the narration here is being payment of bank OD. 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 Yes, so we are done with that point. Let's move to point number 8. And we are told the sum of 3.18 million is to be paid off, to offset the salary payables immediately, and the balance in 4 equal installments at the end of each quarter. So I think in our case here, what we need to do is to account for the amount of payables which was paid, or the amount of salary payables which was paid. So that one is basically quite simple, because what you just need to do is to, once a liability has been paid, we debit the liability account. So we will debit the payables account, or actually the salary payables, which is basically part of the current liabilities. Salary payables with the amount which was paid as per note number 8, that 180, and then automatically we do what? We credit bank. I hope you can be able to see down there. That 180. That 180. That 180. Then we need to give a brief narration for that. We need to give a brief narration for that. A brief narration for that. So being payment, or being partial payment, to who? To creditors. Being partial payment to creditors. Yes. So we are done with that, basically. And then we are told the balance will be paid in 4 equal installments. Are we interested with the amount to be paid in the remaining amount to be paid? No, because if you check on what you're told in part B, we are required to prepare the balance sheet of this company immediately after effecting this. So not even after a quarter, not even after a day, immediately after the company effected this. So we are not interested with the amount to be paid in those quarters. Yes, we are not interested with that. Then number 9, we are told all intangible assets are to be eliminated. Being eliminated means that all the intangible assets will be written off. Will be written what? Will be written off. So I need to create some space here. Yes, so all the intangible assets will be written off. Which are those intangible assets? Automatically, it is all the intangible assets excluding investment. Remember, investment was sold. So we need to write off goodwill and patent and trademark. So how do we write off assets? So basically, we credit the asset account, because assets have a debit balance. We credit the asset account. We debit the capital reduction. We debit the capital what? The capital reduction. So this should be journal entry number 12. We debit capital reduction account. Capital reduction account with the total value for the 2 assets. Goodwill 6,000. Patent and trademark 500. That will give us a total of 65. And then which account do we credit? We credit goodwill with an amount of 6,000. We credit patents and trademarks with an amount of what? With an amount of 500. Narration being intangible assets which were written off, or maybe which were eliminated. Being intangible assets which were written off, or being intangible assets which were eliminated. Yes, so we are done with that. Then note number 10, we are told it is estimated that under the new arrangement, Yes, now that information which we have in note number 10, that one will be used in answering part C. Do we use that in making the journal entries? No. That one will be used in answering part C of the question. So we are basically done, but there is something here we must always remember to account for, even if that information is not provided by the examiner. Remember, this company is trying to clean its books of accounts. Whenever the company is doing internal reconstruction, the company has to write off any accumulated losses. Even if that information is not given to you by the examiner, you must remember to account for that. You must write off the accumulated losses. So if you go back to the balance sheet of our company, specifically at the equity, you'll be able to see that the company had accumulated losses of 5.8. That accumulated losses has to be written off because the company cannot do internal restructuring and still the books of account remain with accumulated losses. That has to be written off. So how do we write off these accumulated losses? So remember, this account always has a debit balance. It is the retained earnings account which has a debit balance because those are losses. How do we write off that account? We credit it and then we debit the capital. We debit the capital reduction. We debit capital reduction account with accumulated losses of 58. And then we do what? We credit. We basically credit the accumulated losses account. Accumulated losses account with the 58. So what is the narration here? Narration is being accumulated losses. Being accumulated losses which were written off. Being accumulated losses which were written off. And I think in our case, basically we have done with preparing what was required. So in part A, that basically what was required. So by doing this, the marks are located here. Are basically what? Are basically 10. In most of the cases, you'll see that the marks allocated here is half for every correct entry, half. So it basically means that you needed like 10 items, not 10 other, 20 items, 20 correct entries here. And basically you get the 10 allocated what? 10 allocated marks. Now, if you can be able to recall the other question which we did in class, after this, the examiner basically was requiring us to prepare the capital reduction account. Even though it is not a requirement in this question, can we prepare the capital reduction account? Let's prepare the capital reduction account, even though it is not a requirement here. Even though it is not what? A requirement. So let's prepare that account. I want to create some space here. So, but basically we have to remember here, our capital reduction will be debited with a total of 3,000. Yes. So let me create some space here. So we prepare the capital reduction account. Capital reduction. Capital reduction account. Capital reduction account. Yes. So, and our figures are in thousands of shillings. Are in thousands of shillings like that. Yes. So we have said as per the first journal entry, basically we said you need to go through all your journal entries, journal entry number 1 up to journal entry number 13 as you check what is affecting the capital reduction. Journal entry number 1, our capital reduction account is to be debited. Is to be debited with various items. So the first entry comes from the account called the trade receivables with an amount of 400. The other entry is in the inventories account with an amount of 800. The other entry is in machinery account with an amount of 800. And basically the other entry is in buildings account with an amount of how much? With an amount of 1,000. So that those particular amounts are basically what? Are debited in this account and then credited in the respective account. In the respective what? In the respective account. In the respective what? Account. Then we go to the journal entry number 2. We check whether the capital reduction account is affected. Yes, capital reduction account, you can see, it's supposed to be credited. The other entry, so this account we credit this. So the other entry is in equity share capital account with this particular amount, 15,000. Journal entry number 3 is the capital reduction account affected. Yes, capital reduction account is to be credited with 15. So the other entry is in bank. Is in bank. That also affects capital reduction. Does this affect the capital reduction? No. Journal entry number 5 Is the capital reduction being affected? Yes, capital reduction account is to be credited. The debit entry is in the interest payable on debentures, which is 220. So then this general entry capital reduction is not affected. Here, capital reduction is to be debited. The other entry is this account is to be debited. The other entry is in 14% debentures with an amount of 200. I can do away with this basically. Yes, so then from there, we have the other general entry here. This one. So the capital reduction account will be actually credited with a total amount of 800 and basically 700. I think we can combine that here. So that will be a total of 1,500 to be credited. This account will be credited. The other entry is in the account called loan from directors with a total of 1,500. That plus that, which will give us 15. So then from there, general entry number 9. So the capital reduction account is supposed to be credited with 1,500. So the other entry is in bank account. Bank account. General entry number 10. General entry number 10 here. Capital reduction account is not affected. General entry number 11. Capital reduction is not affected. General entry number 12. Capital reduction is supposed to be debited. One of the entry is in goodwill account with an amount of 6,000. The other one is in patent and basically trademark 500. And then finally, general entry number 13, capital reduction account will be debited with an amount of 58. So the other entry is in the account called what? The accumulated losses account. And basically we are done. We are done. So remember, you say that this account should either automatically balance or should either balance off, or we have a balancing figure on this side, which is called the capital reserves, which is called capital reserve. The account should either balance off, or basically we have a balancing figure on the debit side, which is known as the capital reserves. Yes. So can we do that? Can we determine whether our account is balancing, or basically we have what? We have a debit balance. That is basically what I'm getting on the credit. Yes, that is basically the figure I'm getting. Yes, so that is also what I'm getting from Ismail. Is that what you have? A balancing figure on the debit side? A balancing figure on the debit side, which is called what? The capital reserve. Is that what you have? Is that what you have? I hope that is what you have. I hope that is what you have. I hope that is what you're getting. Yes. Yes. So basically that is it. What we need to do is we basically move and prepare what is required in part B. What is required in part B? What is required in part B? What is required in part B? In part B, I think maybe first of all I can give you a small breather, and then we come back having a lot of energy. We finish on what is remaining. So let's just take a small breather. We come back at 9:25. We continue. So a small breather, then we come back. Yes. So I want us to continue. Let's continue. I hope you're back. I hope you are back. Yes, so let's continue. I want us to go straight to preparing what is required in part B of the question. And basically, the examiner was requiring we prepare statements of financial position immediately after the internal reconstruction. Statement of financial position. This is as at 1st November 2021. 1st November 2021. So we just need to have a single column here, and we start with the non-current assets. So the non-current assets, we start with basically what you need to do when preparing this. You should be guided by the original statement of financial position. In the original statement of financial position, we have land, buildings, machinery, intangible assets. So number one, we know that land was not revalued. The value for land remained the same. Land was not revalued, and basically its value was 8,000. Then below that, we have buildings. Buildings, we record the value which we have in note number one. Buildings, we have, someone is asking, we go back to the general entries. Let's first of all finish this one. Then maybe I'll see. So buildings was basically valued as per note number one, and basically the value for buildings is 5,000. Is 5 what? 5,000. 5 what? 5,000. 5,000. Yes. So then still in our statement of financial position, below buildings, we have machinery. So basically machinery were valued as per note number one, and the value for machinery is basically 2,000. 2,000. So then below machinery, now I've said we are using the original statement of financial position. So below machinery, what do we have? Intangible assets. We know investment was sold. Will it appear here? No. We know goodwill and basically patent and trademark were written off. They will not still appear here. So mean that all those particular intangible assets will not appear there. So then from there, we move and basically record the current assets. So for current assets, we start with, basically we have two current assets. Actually three current assets in our statement of financial position. We have the first one, which is inventories. Inventories were valued as per note number one to an amount of 64. We record inventory here at 64. Then also we have receivables. Receivables were valued as per note number one to a value to an amount of 36. Still in our statement of financial position, we have cash. This will not change. Because all the other amounts which were received by the company, we have assumed they were received through bank, or any payment which was made by the company, we have assumed it was made through bank. Automatically here, we will have to prepare the bank account and basically determine what is the bank balance, because there is automatically money which remains in the bank balance. And actually, instead of preparing the account, we can have that working here directly, because we know what was received, what was paid. So I think we just need to go through general interest number one. There was no any amount there was nothing affecting bank in general entry number one. General entry number two, there were those particular shares which were issued for cash. The shares which were issued for cash, they had a value of how much? Just go to the shares which were issued for cash and you give me that amount. We try to vary because of time. Was it 4,000? Was it 4,000? 4,000? Yes, 4,000. 4,000. So this is basically money received. So we will take all the money received as positive, any payment as a negative. So we have that amount which was received as per note number two. Note number three, no cash which was received. Note number four, we have the amount which was received from the issue of debentures, and that amount was 1,800. The amount received from the issue of debentures, is it 1,800? Yes, 1,800. Amount received from the issue of debentures as per note number four, please confirm. I can remember it was 1,800, the amount received from the issue of debentures. Then from there we have note number 6, the investment which was sold at 6 million. So this is the cash received, 6,000. Then we have note number 7, we have payment of an overdraft, that is minus. The overdraft was 3,000. The overdraft was 3,000. 3,000. Then we also have note number 8, the payment to the creditors, that 180, which is still a negative. That 180 is a payment. Yes, I don't think we have anything else. That should give us the bank balance. That should give us the bank balance. The bank balance, I hope that is the figure I'm getting from Patrice, of 5620, because the total amount received should be 10,000 plus 18, that is 11,800 minus 6180. Yes, so that one should give us what? Should give us 56 what? 5620. Yes, I don't think we have any other asset here. And basically, we say no need of even getting these totals. We say these totals are not marked. So just move and you record equity. So for equity, we will also be guided by our original statement of financial position. So first of all, we have equity share capital. Equity share capital. We know this equity share capital will change. So the original share capital is basically 20. Instead of preparing the ledger account, let's just do the adjustment here. So then we go to the notes, and basically whatever is affecting share capital, we adjust it here. Ordinary share capital. So we have note number 1 is not affecting this. Note number 2, we have the amount of share capital which was written off. The share capital written off reduces this. So the share capital written off, I can remember, was 15,000. This is the share capital written off. We deducted from 20,000. Then we also have the shares which were issued as per note number 1 in cash. And whatever we add here is the par value. Out of the shares which were issued for cash, the par value for those shares is 25. Is that the position? The amount credited in the share capital for your.
So maybe just a recap. So we have said time value of money. It is that the fact that over time the value of money changes. The value of money does not remain the same. And I'm saying, assuming here now that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million, because this it may be if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount was be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that It is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth. What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting is determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. it's important to respond. Kindly respond if you've seen the handout. Okay, fine, let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number 1. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one. Future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an